All right, so today is Wednesday, August 23rd. This is our last and final session of the semester. Our primary purpose of today is really it's going to be all about you doing your final team presentations. So got a couple of last end of semester logistics to chat about, but we're going to spend most of the time on our presentations today as the final day in class. And again, I'll apologize that I am at the Johns Hopkins main hospital. I was admitted. The procedure that I was supposed to have today got postponed until tomorrow. So it won't interfere with my being here tonight. So they took me off the heavy drugs yesterday, and I'll go back on the heavy drugs tomorrow. So I am lucid and able to grade. But regardless, there may be some interference in people come in. They're checking my blood every 2 hours for some bizarre reason. So I told them to kind of leave me alone during the class, but it may not be they're a hospital. They don't understand things like that. Anyhow, so apologize if any interruptions happen during our session. This is obviously being recorded, and in terms of the presentations, like I said, we have 5 teams to get through. Each team will have 20, for the most part, uninterrupted minutes to make your presentation. Then the team that was assigned to them as their investment committee will have 5 to 10 minutes to ask them questions, have a little dialogue about the presentation, and then we will just repeat that process through all 5 teams. In terms of the way the grading will work is that these presentations are worth 40% of your semester grade. Each of the sections has equal weight, although essentially 10% of that grade, so about 4 points, is going to be the team assigned to you to do the investment committee presentation. I know in the syllabus said that that team has to submit their essentially grade and report of how you do within 24 hours. I'm extending that deadline until Saturday at 5 p.m. because realistically, I'm not going to be able to read it tomorrow if I wanted to. So by Saturday, need you to get into your input on the team that you've been assigned. Basically, give me a grade on a 10-point scale, 0 to 10, and then basically I think it was 100%, and then the rationale. And that's probably one sheet of paper that I'm looking for from each of those teams, and then between my grade and their grade, that I'll then enter the grades in this weekend for the presentations. Okay, and then in terms of the way I'm grading it, as you saw, 10%. So again, 4 points is going to be based on the presentation itself. Like, are you doing a good job with your presentation, etc. And then the rest will be primarily on the content of making sure you cover all 4 of the sections. Right. So before we get started with that, any questions about what we're about to do?
So in terms of grading the other team, we just do one paper for the whole team?
Yes, one paper for on behalf of your team for the whole team that you are grading.
Great,
Now,
thanks.
if now there's somebody on that team you want to individually say, well, this person seemed to do a good job and the other person was an idiot, like you could say that. I would use more polite language than that. But basically, so if you wanted to individually say something about that, you can, but generally you're grading the entire team. Okay. Any other questions? Okay, so a couple other end of semester logistics. Go ahead.
Real quick, can we email you the presentation? I mean, we'll share our screen, but
you should have submitted the PowerPoint by 5 o'clock today. Are you saying your team did not?
Yeah, it sounds like we thought it was just going to screen share it right now.
You're going to screen share it, but I did want it to be submitted, so I had it in front of me as well while you're screen sharing. So
okay.
if you haven't, please have somebody in your team email to me now.
Yeah, well, right now.
And I'll get that one. All right. So just a couple of other things. Where is my Zoom? Okay. In terms of our end of semester items. Sorry, I just got too many windows open here on my little laptop. Under assignments, few last things. Today is the last day to do a course evaluation of this course. So if you haven't done that, please take the time to complete that before the end of today. To do so, feedback is always appreciated. Secondly, here under the assignments where it says investment committee write-up, I posted an assignment earlier today. So that is where one of your team members who is serving as the investment committee for another team member will submit that write-up and grade on behalf of your team. Okay, so this is where you will submit it, grading another team. Okay, and again, I sent an announcement and mentioned last week which teams are grading each of the teams, but I'll remind you as we go through. And then finally, here is where you'll submit your peer reviews of the group case project. So essentially, for each of your teams, you should list all of the team members that were on your team and basically what their level of effort was participating in this group case on a 0 to 100-point scale. So if they fully participated, 100%. If they were AWOL, you never heard from them, don't even know who they are, 0%. Okay, so 0 to 100. You don't have to score yourself. Welcome to, but basically you're just scoring your peers, right? And the way I'm going to be looking at that is the peer reviews will potentially adjust the grades of people for non-participation in the group case. Otherwise, everybody gets a group grade, okay, for the group presentation. All right, subject to the peer reviews. That is also going to be due Saturday, and I put a 5 p.m. submission time Saturday for both the investment committee write-up that you have to do on behalf as a team of the other team, and then the group case you have to do individually on each of the members of your group. So again, just list all the members of your group, 0 to 100%. If you want to add some additional comments, put it on there. And I set it up so you can have this submitted here through Elms. So you don't have to email it to me. I know the syllabus says to email to me, but it would be probably more efficient if you just submit it here. Okay. And then hopefully everybody completed the final exam. I did not get a chance to check, but any issues completing the final exam? And again, I haven't been on Elms the last couple of days due to some health issues, so I don't know if you can see the scores, but I should be able to just look at them and post the scores if you haven't seen those already. So those were auto graded by Elms. All right, so in terms of presentations, just as a reminder, one last time, I had put here under the announcements a little table for the investment committee assignments. So again, as each of the teams present, if you're the investment committee, at the end of their presentation, you'll have 5 to 10 minutes to have a dialogue with that team about their presentation. And then you're the ones that are going to be submitting the grade for that team's presentation by Saturday. Is that one-page write-up? So that's what we're referring to when I say investment committee. Do we have any volunteers on who wants to kick us off tonight?
I think we wanted to go, Disney.
Disney wants to kick us off? All right, so Disney, I'm going to stop my sharing. I'm going to put a 20-minute timer on my iPhone in the background so that, just to be fair to all the teams, like when you get to 20 minutes, you kind of have to be done. I'm going to give you a few minutes to wrap up. But basically, Disney, you're going to kick us off. Home Depot said they wanted to go second, so maybe I think we're going down the order of alphabetical order. But I will say, Home Depot, you are the investment committee. So when Disney is done presenting, you're the ones that are responsible for asking questions. And this is really a peer-to-peer exercise as far as I'm concerned. So I'm going to generally try and stay out of the question fray. So Disney, are you ready to go?
All right, I think we're ready to start.
All right, well, I'm going to start my countdown timer. So
All right.
you got the clock.
Good evening. Well, welcome to our investment case analysis on Disney. Tonight we'll be discussing our recommended trade, the economic and industry factors impacting Disney. Additionally, we will touch upon the financial performance relative to peers and the estimated valuation. Next slide, attitude 2. And one more slide. So we believe that Disney is a buy, as our target price is just over the 10% threshold. This is due to the long-term potential upside as a post-COVID industry leader. Although the company has invested heavily in creating new content and has some political blemishes, we believe that Disney is refocusing efforts on their competitive advantage, and they will be more successful in the future. Next slide, please. Diving into the EIC analysis, even though we are rating this company technically as a buy, there are a few economic and industry headwinds that Disney will have to overcome. From an economic perspective, the industry's weighted average beta is 1.08, and Disney is even higher at 1.11. This means that compared to the S&P 500 index, both the media and entertainment industry, along with Disney, are highly sensitive to systematic risk. Thus, both the industry peers, along with Disney, experience higher volatility in their stock prices. Next slide, please. Diving into the competitive forces that are impacting the industry, it is easy to see that the industry is highly contested and only high-performing established companies like Disney are likely to survive. We believe that the competitive rivalry is high because major competitors in each major market segment, from film and television to theme parks to streaming services, are well entrenched and have substantial financial resources and are actively competing for market share. We believe that supplier power is low due to the decentralized supply base. In addition to a majority of the suppliers provide raw materials for merchandising, which is very low cost. And also, it's important to know only a few of the select suppliers have higher power due to providing highly specialized software. Moving on to buyer power, we believe that that is low because there's an extremely loyal fan base. And even the low-cost merchandise that Disney is able to sell and all the competitors, they're actually sold at a mildly higher price than you'd expect. And people are willing to buy it. The threat of substitution is moderate. Disney has multiple media and entertainment company competitors, such as Netflix, Amazon, Apple, Hulu, HBO. And the switching costs are very low. Even the indirect switching costs through other means of entertainment are very low. So we believe that is moderate. And then threat of entry is also low because there are very high barriers to entry. This industry takes years to build organically, or it takes a lot of excess capital to acquire new content. And typically these theme parks and things are highly capital intensive. So at Tutu, could you go back one slide? Yeah, just stay here for a second. Just want to talk about go forward one slide. There we go. Here we are. Looking at the overall ROIC and WACC spread, you can see that the industry isn't very attractive. But we believe that the spread as a whole will continue to worsen in the next 5 years. ROIC is 2.71%, and the WACC is nearly 9%. Next slide, please. This brings us to in 5 years, we believe that competitive rivalry will remain high. The supplier power will transition from low to moderate, and that's due to those the more specialized software and technology providers. There's going to be further competition for those few companies. We believe that buyer power will remain low, and then the threat of substitution will actually transition from moderate to high. And this is because the competition that Disney is facing has really stepped up their game. They've created award-winning content while Disney hasn't. We believe that switching costs for even indirect substitutes, like I mentioned before, will remain low. And Disney, among other competitors, are going to be forced to decrease their margins in order to maintain competitive. This will go right into productivity, and we believe that the higher costs incurred will be required to generate new content. We also believe that the threat of new entry will remain low. So focusing back on Disney, Aditya, can you go to the next slide, please? So focusing back on Disney, we believe that based upon comments that the CEO has made publicly and action Disney management has taken, such as recently reducing their headcount by 7,000 people, we believe that Disney is refocusing efforts on their core competitive advantage, which is their theme parks and resorts. These theme parks and resorts complement their other media content, but they have experienced higher margin decrements due to the pandemic. As we turn the page on the COVID-19 and with the revitalized focus on the blockbuster franchises that have made Disney a household name, we believe that Disney will come out ahead of competitors. However, as a reminder, if Disney continues to throw money at non-award-winning content, their productivity and margins will further decline, which will continue to impact their spread. I'm going to turn it over to Aditya to discuss their historical analysis. Next slide, please.
Thank you, Adam. For the historical analysis, this is the ROIC tree, but we have broken it down in the next slide so that we can clearly see it. The 5-year end-of-year ROIC declined by 81.9% over 5 years. From that decline, 76.1% is from the pre-tax end-of-year pre-tax ROIC, and 5.8% of that 81.9% decline is the tax rate is responsible for that. The tax rate increased by 190.3% over 5 years. I'll talk briefly about the pre-tax ROIC. The pre-tax ROIC was a 5-year average of 7.4%. There was decline in both productivity and profitability and productivity, and there was a major decline in 2019, as we can see here, from 22% to 8.7%. It was due to general operations decline. That was partly offset by the purchase of 21st Century that I'm going to discuss on the next slide. And from 2020, 21, and 22, those are the effects of COVID-19. On the tax rate in 2019, there was a sharp increase in the tax rate from 11.3 to 21.7. That was because of a major tax gain that they recorded in 2018 from the implementation of TCJ Act. In 2020, the tax rate was negative because the company profitability declined based on COVID. And in 2022, there was decrease in deferred tax assets. That's why it went up to 32.8%. And on the next slide, we're going to dive deeper into the profitability. The operating margin decreased by 68.4% over 5 years. As we can see from the operating margin, the gross margin declined. The decline in operating margin is from the decline in gross margin that declined by 19%. This SG&A increased by 31.9%, and depreciation also increased by 23.2%. The operating margin decline in 32% is mostly from legacy operations, and that was partly offset by the purchase of the 21st Century. And in 2020 and 2021, that was mostly from COVID. Then talking about productivity, in 2019, Disney acquired 21st Century Fox, and from that, their invested capital jumped up drastically in 2019, and but over the 5 years, it was an increase of 32.2%. The increase in invested capital is accounted for by the sharp increase in operating working capital to sales. As we can see here, it is negative. Although it has a positive impact on the ROIC of the company, we do not think it is sustainable in the long run. for them to have negative working capital. The PP&E also dropped. PP&E dropped by 8.6%, and the intangibles increased by 75%. The intangibles is mostly from goodwill and from the purchase of the 21st century. So I will hand over to the next.
Thanks, Adetutu. So just looking at the CFI, what does that tell us about Disney? Well, overall, their free cash flows declined by about $30.6 billion over the 5-year period. Now, big drops of 60 billion in 2019. That was most likely due to the 21st Century Fox purchase, which in my research was about $71 billion for that acquisition. Now, looking at the gross operating cash flows, they actually rose by 49.9 billion over the 5 years. Of that, they reinvested about 26.2 billion back into operating activities. But they did spend 54.3 billion in goodwill and intangibles. We did notice that revenue declined in 2020 by about 2.7 billion, largely because of COVID, most likely. But that probably isn't the biggest factor in the overall CFI here. They did also put 7 billion in excess cash, but they began pulling some of that excess cash out starting in 2021, probably again to fund some of the new content that they were purchasing and that acquisition. They also added 23 billion in net non-operating assets for liabilities. Interestingly, their average investment rate was about 52%, and their capex over depreciation was 141%. That shows they are trying to grow a little bit, but not too aggressively over this period. So that left us with negative 53.1 billion that had to be financed by investors. So they did have an increase of 6.5 billion in interest, but they also increased their debt quite a bit overall for the period, about 26.8 billion. And two big jumps were 2019 to 2020. Again, as I said already, to fund the acquisition and some of their content development and covering some of the losses they incurred during COVID. And then we're looking at the equity cash flows. They actually suspended their dividends, which I thought was interesting, and they have no plans to bring them back. That was in 2020. So they're saving a little bit there. They also stopped repurchasing shares after 2018's 3.6 billion, but did start issuing some shares as well for a total of 1.4 billion over the period. And lastly, they increased their equity quite a bit by 36.9 billion and their minority interests by about 8.5 billion. But we can move on to the multiples analysis now.
Next slide. Thank you. So when looking at the multiple analysis, we're comparing Disney, Fox Entertainment, and Paramount Pictures. When you're looking at the PE ratio for Disney, next slide, Adetutu. The main assumption we made was for the return on equity. For FY24, the return on equity was only expected to be 8.4%, but we found that number to be on the low end due to the effects of the pandemic. So we took a 3/4 average of the ROE prior to the pandemic, but after the 21st Century Fox acquisition, and it ended up being an ROE of about 13.11%. We think this more accurately represents our outlook on Disney's ROE. Then we use GoalSeek to back into the 7.23 PE given by Bloomberg to come up with that 8.78 growth rate you see on the screen. Next slide. As you can see, Disney trades at a premium for the PE ratio among its competitors. With the sale of 21st Century Fox, Fox has remained a strictly cable business, which would explain why its long-term outlook is low. Paramount, like Disney, has entered the streaming space and attempted to diversify their operations, but Disney just has a stronger brand value and more diverse product offerings, which we believe justify the ROE adjustments as opposed to leaving the other two stagnant. When looking at the numbers, it's immediately evident that the higher PE is driven by Disney's higher expected net growth income. Even when looking at the middle of the road cost of equity, Disney still outperformed Fox. And we believe This is because Fox is too reliant on its income from Fox News and has bet against sports moving to a non-pay TV space. Although there is some competition from Paramount in the streaming space, they don't have much must-see TV content to attract customers at this moment. Can you go 2 slides ahead, Attitude? Another one. Okay. Now when looking at the EV/EBIT ratios, when we attempted to back into the G, with the expected ROE IC for FY24, we ended up with a negative growth. We didn't think this was accurate, so we basically started with our target growth, which we'll explain later in valuation. So that was 8%, and we ended up backing into the expected ROIC, ended up with 9.94%. And we believe this number is more accurately represents our outlook on Disney's expected return on invested capital. Next slide. As you can see, once again, Disney has a premium EV/EBIT ratio amongst its competitors, and the largest driver is the growth, which offsets the tailwinds created by Disney's higher expected tax rate, higher WACC. When looking at EV to sales, Disney again trades at a premium versus its competitors, largely due to operating margins versus its competitors. Even though Fox is the most productive, they're unable to overcome the headwinds and higher margins. It's interesting to note Paramount has a negative productivity, which is a result of their negative ROIC. And then I'll let Caitlin talk about valuation justifications. Next slide.
Caitlin, are you there?
Caitlin.
Hey, I'm back. I'm really sorry. My internet cut out, so I'm back. Okay, are we ready for this slide? Okay, great. So we're now going to walk through the valuation, and if you could move to the next slide, Attitude 2, following the cash flow. This is the as-is model with a share price of 87.49. The key takeaways on this slide is that the continuing value growth is 7.71%, with the revenue year-over-year growth of about 6%, going down to 4% in 2027. The EBITDA year-over-year growth starts out at 22%, going down to 12% by 2027. And then the EBITDA margin is starting at 6.9%, ending up at 24.8% by 2027. So next, we're going to walk through the reasons for how we created the bull, bear, and target models. On this summary slide that you see here, we show how we adjusted each model relative to the as-is model. So for example, in 2024, the bull model, we increased the revenue year-over-year growth by 2.4%, EBITDA year-over-year growth by 7.4%, and EBITDA margin by 1.9%. So these numbers are all relative to the as-is model. So next slide, we're going to go into the bull model justification. First, on revenue growth, we expect that revenue will grow at a slightly higher rate in the next 5 years, with a concentration of that growth occurring in 2024 and 2025. On average, we increase the revenue growth 1.25% higher from the as-is model in our bull model. And the reason we did this is, firstly, Bob Iger, who became CEO of Disney for the second time after it struggled during the pandemic with its then CEO, he expressed plans to increase profit by focusing on Disney's core business, which may mean slimming down some parts of Disney that are not perceived to be core to the company. So given these plans, we anticipate some revenue drop from removing non-core revenue streams. So we kept the revenue growth more modest while focusing on other EBITDA and EBITDA margin growth. And then moving on to EBITDA, the increase there, go back to the bull model. So we had an increase, moderate, significant increase here because of Bob Iger's statements that he's made in interviews about cost-cutting measures. And then that follows through to the EBITDA margin, and then in the continuing value growth, we increased growth to 8.225% to signify that there would be some growth, but we didn't increase it so significantly given his plans to slim down the company. And then with the bear model, we took the opposite, reducing by these averages here. And then we assumed for EBITDA that they
we're at time, so I'm going to give you 30 seconds to wrap up. So make sure you get through the target.
Sure. And so for the target, we took for the target here, we took kind of a middle of the road for some of these. For revenue growth, we split the baby right down the middle between the bear and the bull. And then for EBITDA, we erred more on the side of the bull, thinking that Bob Iger would be successful in all of the statements he said publicly about focusing on cost cutting. And given that he's demonstrated this with layoffs of 7,000 people in May, creating a task force over the summer that's focused on cost cutting and using AI specifically, we think there's a good chance because of his focus, that he'll be successful in that. So we erred more on the side of the bull for the EBITDA and EBITDA margin. But then on the growth, we took just a slightly above the as-is model. So more conservative on revenue and on growth, and then a little more bold on EBITDA and EBITDA margin. Ultimately, we come up with 97.87. And this is a moderate buy. It's just over the 10%. It's at like 11% from the as-is. So it is technically a buy, but it's not. If there were other investment opportunities that were significantly more over the hurdle, then I think it'd be worth looking at that. So we're considering it a moderate buy.
Great. Thank you, Team Disney. Home Depot, you're welcome to engage as the investment committee.
Great. I'll start us off. I just wanted to hit on something that you mentioned in the EV/EBIT multiples analysis. You mentioned that you had to work backwards into ROIC for Disney. Did you have to take a similar approach for both of the other competitors, or were you able to use their ROIC as is?
We talked about it a little bit. We used it as is, just because we thought that Disney was not only more diverse than the other two companies, but the pandemic, we think, skewed them more than the other two companies, because essentially, resorts is probably about a third of their company, resorts and entertainment. And for basically 2.5 years, they didn't get anything out of that. So we were kind of counting on that picking up again, while the other two companies are kind of just, business as usual.
Okay, thanks. With regards to the company as a whole, I guess first question is, how much of that is really profits or lack thereof from the streaming side? And then also, what has the impact of that been on, for example, when looking at your historicals, the pre-tax ROIC decline?
Sorry, can you repeat the question, please?
Yeah, so regarding streaming, and I suppose that might be part of the general content creation, but do you know kind of what the percentage of streaming is to Disney's bottom line profit? And then if so, what is the impact of that been, for better or for worse, on the ROIC?
Okay, thank you for that question. The section of the old company that we really looked at, especially for their, we looked at the theme parks. That was about 1/3. The rest of the company is about 2/3. I'm not sure how much of the 2/3 is streaming, but they also have some hotels. The hotels are not a significant percentage, and I would say out of the 2/3, I'm not sure, but we can remove at least 1/3 for the theme parks, because we talked at length about their advantage, their competitive advantage for that. So, does anybody else have response?
Yeah, I'm not sure if anyone else on the team wants to jump in, but Yeah, their streaming has only recently just started to maybe turn profitable. It hasn't really been profitable at all in our historical analysis. So the ROIC here is probably impacted very negatively because they were spending a lot to get content and also to get people into the door onto the platform. So they were kind of offering promotions and stuff like that. So that probably reduced, especially like in 2019, the ROIC quite a bit.
I would add to that Netflix, has started in 2007. Disney Plus came out in 2019. Bob Iger's statements he's been very complimentary of Netflix margin and how they are able to get content out without spending so much on the marketing, and even admitted that Disney needs to get better at that. They don't have the right balance ratio of getting their content out and how much they spend on getting the word out about their content. So that's part of his cost-cutting initiative, is to get Disney streaming more profitable and more on par with Netflix profit margin.
Next question from our side. I think it sounded like a lot of the buyer recommendation was based on that ability to cut costs, rather than sort of the industry showing any sort of real indicators of growth. Do you think, considering streaming is 2/3 and considering there's that much focus on that, and that Disney hasn't really shown an ability to keep that low, that there's enough evidence for you? And if so, where does that evidence come from for you that they're going to be able to do that?
Sure, I can take this one. Attitude 2, do you want to go to the bull model slide? And I can walk through, in addition to the Disney Plus sources of revenue. But to answer your first question about Disney Plus in it of itself, so in addition to the profit, kind of putting profit to the side, the actual growth there, they grew pretty exponentially compared to Netflix to get to the amount of subscribers that Netflix had. So they've grown impressively in a short period of time compared to Netflix. And I think their content and their strength of brand, something I read, you don't really know what you're going to get with a Netflix original, but you tend to know what you're going to get with a Disney production. They have a stronger market brand recognition there. And I think that's going to drive the continual increase in Disney Plus subscribers. But even in addition to that, we've also accounted for, and I apologize for not getting to this in the presentation, but an increased demand in international theme parks. The US theme parks are not so much driving that demand, but international theme parks, especially in Shanghai, where they have pent-up demand from not being open most of last year due to zero COVID policy. They're making 3 new cruise ships, and they're also looking at licensing content to other streaming platforms, which would be additional revenue. And then we're also anticipating, AI innovation, creating new revenue streams, given that they've got a task force specifically dedicated to AI.
Going back to the, I guess, direct-to-consumer segment that Disney has, do you see any long-term impacts from the Screen Actors Guild strike on content creation for Disney? And I guess second piece of that, could it possibly be a short-term benefit if they've been investing in poor content?
So I can take this one. So the Screen Actors Guild is going to impact all competitors, not just Disney. However, Disney has a very loyal fan base. So even if the content isn't good, for our research, even if a Star Wars movie or a Marvel movie has poor reviews, it still brings people to the theater. So Disney is more able to weather that storm than any other competitor.
Yeah, and I can also add, this might be a pipe dream, but I do believe that if you've already seen this, that AI can create a full film on its own. So if they're investing in AI, they could kind of bypass the writers and start, producing Disney content with AI. So.
Okay, so question related to some core competencies that you were talking about. So you're mentioning that streaming might not be the best source of revenue for Disney, but they are shrinking back to their core competencies, which involves things like focusing on their theme parks. So with that, in recent news, Disney has been forced to take more of a political stand in its Florida locations with this like ongoing battle that they have with the local government in Florida. And I'm wondering if you think that this kind of publicity and forcing Disney to take a political stand in a way is going to impact its branding, which impacts its customer base, which you have talked a lot about how the customer base is really strong. But I'm wondering if that was like these little political stands that they're having to take now in their theme parks is was that taken into consideration in the valuation at all?
Yeah, I can take that and Adam, feel free to add anything from the EIC analysis, but it wasn't for like long-term view because we thought it was more episodic and not like worth looking out in the 5-year plan. And also given that Disney Plus is a significant source of revenue. So it's not that Disney Plus would be removed at all. It's just that Disney Plus is not at the profit margin where they want it to be. So they need to chip away at the costs that are making that profit margin narrower than they want. So I didn't mean to say that Disney Plus wasn't core. I think Bob Iger would say Disney Plus is very core. What he said is not core is Nat Geo. So like kind of things on the periphery like that. So yeah, in addition to that, David, do you want to say what you just put in the chat?
Yeah, no, it just helps that DeSantis, who's been one of the main people attacking Disney, is now going to be focusing his efforts on running for president.
All right, well, I think that kind of gets us to about a 10-minute mark. And I just want to say thanks to both teams for kicking us off. Great job, Disney, and very insightful questions from the Home Depot Investment Committee team. So well done all around. Let's go ahead and move to our second team of the night, and that wanted to be Home Depot. So you guys, if you want to get ready, go ahead and reset my timer here.
Great. I think we're ready to
Okay,
share
ready?
with the group. Chris, do you want to start us off?
All right, you guys are on the clock, Home Depot.
Thanks, Pat. I'm still seeing the Home Depot ROE screen. If you want to get to the top there. Hit us with a jingle. All right, we're speaking to you about Home Depot today. Our team is Isabon, Kathy, Gina, myself, Patrick, and Tom. And our overall recommendation is for a hold at a target valuation of $340. Isabon, you want to kick us off?
Sure thing. Thanks, Chris. So the home improvement industry is sensitive to economic fluctuations as seen by the industry average beta close to 1. As we all may recognize, home improvement projects are paid out of discretionary funds. And the industry boomed during the pandemic due to greater time and availability of these discretionary funds. However, inflation and high interest rates are now reducing growth in the short term. And in the long run, industry growth is expected to keep in line with GDP as the need for home improvement will always remain. Home Depot in particular has a slightly better beta than its competitors. With that, we have to consider that 90% of the company's revenues are US based, so it is closely tied to domestic economic fluctuations. Next slide. Here you can see the industry's ROIC to WACC spread of almost 24%. The home improvement industry is an attractive one to invest in, and Home Depot's spread is 28%. So it's the highest of its competitors and even exceeds the industry average. it truly does have competitive financial advantage over the others. Looking at the 5 forces analysis, competition in the home improvement industry is strong and expected to remain strong as the main established players, Home Depot and Lowe's, vie for market share in more and more saturated markets. Though hardware and specialty stores offer specialized services, the threat of substitutes is medium as large retailers offer more online offerings and improve customer service. The potential of new entrants is low and expected to remain low due to the capital and labor intensive nature of setting up a new differentiated brand that is able to deliver the same broad range of services. Similarly, the power of suppliers is low and also expected to remain low as suppliers rely on home improvement stores to access individual consumer market and sell large quantities of products through exclusive contracts with retail stores. Moving on to the power of customers. Here, power of customers is high and will likely remain high as home improvements retailers mostly provide similar offerings. Differentiation occurs mostly through convenience, i.e. location, and price, though stores are also differentiate based on clientele. For example, 45% of Home Depot sales are to professionals compared to around 25% of Lowe's sales. And so it's 45% of Home Depot sales to professionals versus 55% to your DIY, just generic customers. A strong online presence is also needed, which requires a delivery network currently provided by strategic partnerships. Tom?
Thank you, Isabon. As previously noted, Home Depot has a significant financial competitive advantage shown by its current spread of 28.18%. For Home Depot, the pandemic rapidly increased demand, but recent interest rate hikes have led to lower growth in the short term, a construction phase, if you will. Looking forward for Home Depot to remain the leader in the industry, they'll have to continue investing in customer service and specialized associates. These associates are long-term investments that will have higher labor costs. Home Depot will also continue to invest in the convenience of online retail and delivery, which they are already pursuing through a partnership with Walmart's last mile delivery service, Go Local. In addition, the company will continue to invest in its customer experience and loyalty platforms, examples being purchase history tracking, suggested purchases, and tailored deals and coupons. The level 1 key drivers of the ROIC tree are shown in the table. Over the past 5 years, Home Depot's return on invested capital has shown a decline, decreasing by 13.3% from 40.6 in 2019 to 35.2 in 2023. In 2019, the end-of-year pre-tax ROIC was 53.1%, which decreased to 46.3 by 2023, representing a 12.9% decrease. This trend suggests that the company is generating lower returns on its invested capital. Lastly, the tax rate has increased very slightly from 23.6 in 2019 to 23.9 in 2023, which is a 1.3% increase, but that is not the main reason for the slower growth on return on invested capital, which is what Kathy will jump into next.
Thanks, Tom. When we look at the level 2 key drivers, we see on the top side of the tree that Home Depot's operating margin grew by 6.4% over 5 years, from 14.4 cents in 2019 to 15.3 cents in 2023, leading to an increase in returns. Gross margin did decline slightly by 0.9 cents or 2.5% over 5 years due to increased costs associated with inflation. However, growth in operating margin is mainly for better control of SG&A expenses and reduced depreciation. Specifically, SG&A expenses dropped from 20 cents in 2019 to just above 18 cents in 2023, indicating efficient management and cost-cutting measures. Depreciation also fell by 8.7% over the 5 years, implying lesser assets to depreciate and/or assets that were fully depreciated. The lag in returns, however, is due to productivity metrics. Home Depot invested capital to sales ratio increased by 22.2% from 2019 to 2023, with increases seen in all measures. So operational working capital to sales ratio rose by 78.5%, suggesting inefficiencies in managing short-term assets and liabilities. The PP to sales ratio remains steady at about 20 cents in both 2019 and 2023, indicating consistent PP&E investment. And then intangibles to sales actually jumped from 21 cents in 2019 to 47 cents in 2023, mainly due to the reacquisition of HD Supply Holdings in 2021.
Looking at the CFI, there was strong NOPLAT improvement driven by top line revenue growth in 2021 through 2023. There was the gross cash flow increased from around 14 billion in 2019 to over 21 billion in 2023. There's significant capital expenditure in 2020, mainly in fixed assets, around $6 billion, resulting in a gross reinvestment rate of around 61% for 2020. That slowed to 12% in 2021, but then picked back up to 32% in 2022 and up to 52% in 2023. The last 2 years have been more focused on net working capital rather than the 2020 focus on fixed assets. In 2021, they had less capital expenditure, and instead choosing to prioritize the acquisition of HD Supply. The free cash flow in 2023, 10.3 billion, was actually lower than their free cash flow in 2019 of 20.9 billion. However, they did see their highest free cash flow in the year of 2022 at 13.5 billion. Overall, very healthy cash flows. We would say that the lack of consistent growth would probably be just down to higher reinvestment rates in 2022 and 2023. So what are they doing with the cash? In 2022, they had around 19.6 billion available to investors. They spent 14.8 on share repurchase, which has been a core part of their return to shareholder strategy. They spent nearly 7 billion on dividends, and they spent around 1 billion on interest payments for around the $2.8 billion that they borrowed to cover that difference. 2023 was a similar story, nearly $11 billion available, 6.7% or 6.7 billion spent on share repurchase, 7.8 went to dividends, and they had an interest payment of around $1.2 billion, needing a borrowing of around $4 billion to cover that difference. Over to you, Pat.
Great. So now let's take it away with the multiples analysis. Looking at the PE, you can see the following system we used, green and yellow, to indicate who was strongest and weakest in each category. It's clear that Home Depot was dominant in the majority of these ratios. The only area where their competitors are better off is in cost of equity, where Tractor Supply's 9.1% outdoes Home Depot by 0.6%. Home Depot's projected growth rate is nearly a full point better than both of its peers at 5.58%, and their ROE of 37% is superior to the 32% from Lowe's and 20% from Tractor Supply. Despite Tractor Supply having that lower cost of equity, Home Depot still has the highest spread at 27.3%, simply because of their significantly higher ROE. We'll come back to ROE in the next slide because significant stock buybacks, which Chris hit on a little bit, have created negative book value for their equity. But overall, Home Depot is the strongest of these competitors by a wide margin. It's a similar story for EV over sales and EV EBIT. Home Depot's WACC at 8.93% is the only area where Home Depot is worse off than the other three, with a 8.63% and 8.17% for Lowe's and Tractor Supply. Home Depot's significantly higher ROAC at 32% to 25% and 17% for their competitors gives them the highest spread at 23.07%, more than offsetting their slightly higher WACC. On EV to sales, Home Depot's productivity is industry leading at 34 cents in the dollar compared to 41 cents for Lowe's and 47 cents for Tractor Supply. This advantage is further solidified by their best-in-class margin at 10.9% over Lowe's 10.3% and Tractor Supply's 8%. As on EV to EBIT, as mentioned before, the higher growth is key, after which their spread just solidifies the dominance in this industry. Their spread of 23% is much stronger than Lowe's 16.37% and Tractor Supply's roughly 9%. As I mentioned, and Chris hit on a little bit, as you can see from this Bloomberg slide, Home Depot has reported ROE forecasts that vary from more than 1,000% to less than a negative 1,000% over the next few years. And without really knowing much else about the company, it's pretty clear that this isn't necessarily accurate. So we needed to dig a little deeper. Over the last couple of years in the low interest environment that we've been experiencing, Home Depot has been aggressively buying back stock, which has given them a negative book equity, which renders this ROE unusable for our multiples analysis, which caused us to need to find another way to work back to find ROE. And we ended up using two different methods in order to make sure kind of a sanity check that we were getting towards the right number. But I'll leave more on this for the question phase.
So in our as model, currently Home Depot's revenue growth is projected at 2.9%. This baseline is derived from past performance and current market conditions. This growth actually appears to be on the conservative ground, in the fact that while Home Depot saw an impressive 40% sales growth in post-pandemic, it's expected to slow down in 2023. And this baseline appears to be factoring in both the historical surge and the potential future decline, providing a moderate growth rate of 2.9. EBIT margin is at 14.5. The EBIT margin is determined by using the projected EBIT margin for the year 2026. Home Depot has challenges such as commodity deflation, reduced big ticket spending, and the need for workforce improvement. These challenges could compress margins, yet its positioning as a top-tier retailer and favorable long-term industry drivers should balance out the margin to be at around 14.5%. Its current tax rate is 24.5%. This rate is an external projection from Bloomberg analysts, which would likely take into account the broader economic context, regulatory environment, and the historical tax rates of Home Depot. The continuing growth value of 5.6, this base value indicates a belief in Home Depot's steady and sustained long-term growth. Given their e-commerce growth, industry leadership, and ongoing strategic investments, it's plausible to anticipate a steady long-term growth rate of 5.6. And all these metrics lead to Home Depot's current stock price of $328.21. Now, as we look at the bull scenario, so revenue growth climbs to 7%. This optimistic scenario, Home Depot is expected to continue capitalizing on its strong e-commerce platform, which has positioned it as one of the largest e-commerce companies in the United States. Home Depot's partnership with Walmart is assumed to further enhance Home Depot's fulfillment capabilities and potentially increase the speed and efficiency of online orders. Their professional customer segment, which accounts for a significant portion of Home Depot's sales, is anticipated to maintain strong spending levels. This assumption here is that the economy rebounds and construction activity accelerates. Pro customers would continue to frequent Home Depot, thereby boosting revenue growth. In addition, consumers are expected to stay in their homes longer and will continue to reinvest in their properties as low interest rates from the pandemic era are keeping consumers from purchasing new homes. We also anticipate EBIT margin to increase to 15.6%, and this assumption is based on the expectation that Home Depot will successfully manage its operational efficiencies despite ongoing challenges. Investments made in technology and supply chain improvements are anticipated to start yielding significant returns in this scenario. Next, the tax rate decreases to 23.6%. Here we assume that in this bullish scenario, that the belief that Home Depot might capitalize on tax incentives or the broader economic environment becomes more business friendly. And then lastly, the continuing value growth increases to 5.8%. This assumption suggests a belief in Home Depot's strong and sustained long-term growth. It assumes that the company's strategic initiatives to invest in technology, e-commerce, and pro-customer relationships will enable it to capitalize on favorable long-term industry trends, such as increase in home ownership rates, a rebound in construction activity, and continued consumer interest in home improvement projects. In this scenario, Home Depot is expected to continue to gain market shares from its smaller competitors, solidifying its position as an industry leader, with the stock price going to over $400.
All right. So in our less rosy bear scenario, we see revenue growth slowing down to 2.5%. And in this bear scenario, consumer caution is expected to lead a significant slowdown in sales, with rampant inflation, declining real incomes, a sharp drop in US housing purchases, and increased discretionary spending restraint amongst consumers. The revenue growth could be limited. The projected fall in same-store sales and a decline in pro-customer sales, as indicated in the outlook, further substantiate this reduced growth rate. EBIT margin drops to 13.6%. Home Depot faces volume deleveraging and a significant $1 billion investment in employee compensation. Additionally, there's a potential impact from commodity deflation and reduced big ticket spending, which are likely to exert downward pressure on margins. These headwinds, along with the potential for decreased consumer spending, may contribute to a lower EBIT margin. Tax rate, we also increased to 25%. The potential for economic downturns or policy changes could lead to less favorable tax conditions. And as mentioned, broader economic conditions like inflation are already a concern. So a higher tax rate in this scenario might reflect an anticipation of an unfavorable regulatory environment due to these economic conditions. We also have the long-term growth rate fall to 5.6%, considering the numerous challenges outlined in the outlook, including decreased customer transactions and potential market contraction. Long-term growth prospects are assumed to be more modest in this bear scenario. And this reflects the expectation that Home Depot might experience subdued growth in a challenging market. But then in our target scenario, we want revenue growth to increase to 3.4%. This growth rate might reflect a balanced view of Home Depot's resiliency and industry leadership, while also acknowledging headwinds like inflation, reduced consumer spending, and slowdown in the housing market mentioned in the outlook. It also suggests a scenario where Home Depot navigates through current challenges and maintains a moderate growth rate. The EBIT margin increased to 14.9%, and this margin is set optimistically compared to the bear scenario and considers Home Depot's ability to manage its operational costs effectively. The outlook mentions that while Home Depot is facing short-term challenges like volume deleveraging and wage investments, it's positioned well in the long term and is expected to capitalize on industry growth drivers. We maintain the tax rate at 24.5%, consistent with the as-is models, and suggests that in the target scenario, the tax environment is expected to remain relatively stable. This could be based on the assumption that despite economic fluctuations, significant changes in tax legislation affecting Home Depot are not anticipated in the near term. Continuing value growth remains consistent at 5.6% to align with Home Depot's strategic initiatives and its capabilities to secure long-term growth. It reflects a belief that despite short-term challenges, Home Depot will leverage its e-commerce growth, leadership in home improvement industry, and other strategic initiatives to maintain a steady long-term growth, as suggested by the outlook. So our final recommendation is what we would call a stronghold at $340.26, which is about 3.6% higher than the as-is model, but still feels overall fairly positive about Home Depot going forward. And with that, we are ready for questions.
Thank you, Home Depot team. Actually, I just gave you the same 30 seconds that the other team had, so right up a little about 30 seconds over on time, but good job. How about, is it Planet Fitness? You're the investment committee for Home Depot, so you have the floor.
Sure, I can start us off with a question here. So interest rates are at the highest rate they've been in about 20 years, which plays a big factor in, I guess, people doing home improvement projects and construction. How did you, I guess, consider this in your analysis, given a higher target price than the as-is model that we have?
I'm happy to take that. I think, as Kathy mentioned, I think, you know, the fact that the highest interest rates are there probably are going to indicate that people are less likely to move, and less likely to, you know, less likely to take the money that they are able to save, and would rather stay in their places where they are and, you know, potentially reinvest in that. So it may be a little bit of a balance As mentioned here, it's a fairly conservative look, but we believe that those factors actually work out to be a positive in the overall. I don't know if anyone else from the team wants to answer that.
Yeah, there's also a housing stock shortage. So I feel like less people are going to actually be able to move, and whatever discretionary income they have, they're going to sort of do it and use it to improve their own house or hire contractors to do it.
Thank you.
I can go next. I know you mentioned in your briefing that you had an alternate approach to calculating the return on equity. Could you walk us through that real quickly?
Yeah, sure. Yeah, I'll walk you through that a little bit. We use two different methods to work backwards to ROE. One of them used primarily ROIC and cost of debt. And this is kind of really what we stuck to. But we use a second method using growth and enterprise value in order to kind of sanity check that. And we found that we were within like a 5-point spread of where we expected to be. So if you can see these two different methods on screen, this is really how we worked backwards to find an ROIC, given that we knew it wasn't 1,500%. Sorry, ROE.
To add to that, I think that the top one obviously makes an assumption on ROIC based on what we get out of the Bloomberg report. The bottom makes an assumption on growth, which we obviously took from a lot of the other analysis that we had. So somewhere along the line, you needed to sort of make some assumptions, and by using this sort of dual approach, we were able to sort of validate that the assumptions on either were reasonably sound.
Thanks for the question.
Thanks.
Anything else from the Planet Fitness team?
I'll say something if no one has anything. I was just interested in the spread with your bull bear target and as is values that you had. I thought it was interesting how the target is moderately, or I guess like a modest growth from the as is, but the bull seems like a significantly higher amount of growth, and then the bear is like a smaller. So I guess like can you walk through again what is like the main lever between your target and your bull? I see that you have like you have 15.6% EBIT for increase for the bull, and then 14.9% for the target, and then the long-term growth rate seems similar, but you have like a significant increase from 2.4 to 7% in your revenue growth. Do you mind just walking through that again?
Yeah, sure.
Some more detail, I guess. I'm just curious.
Yeah,
Thank you.
absolutely. Chris or Patrick, would you mind going back to the bull scenario? So Home Depot is definitely an industry leader in their environment. They surpass Lowe's, and they are definitely more pro-friendly as opposed to their competitors. And as Chris alluded to earlier, people are investing in their homes. And with a mild recession coming, people are still planning on investing in their homes. So to capitalize on that, we see that their revenue growth can increase in that space from their pro customers, but also they're expanding their e-commerce partnerships, their e-commerce and their partnerships to gain greater market share. So we anticipate that given their extra options that they have available online to compete with like Lowe's, which is known to have more decor options than Home Depot. Those are bigger ticket items with greater margins. So that's why in a bull scenario, we chose to go with the 7% growth increase there.
Okay, cool. Thank you very much. Honestly, yeah, it was very thorough, the rest of it. So thank you. Thank you all.
Thanks.
Anyone else?
There's no other questions from them. I'll jump in with one. I know Lowe's reported some very disappointing earnings this week. Is that a trigger of sort of what's going on in the industry right now? Or are they more unique and Home Depot isn't going to have the challenges Lowe's is having?
I'll take that.
happy to-
A big
Go ahead, Pat.
differentiating factor between Home Depot and Lowe's is that Home Depot has a much bigger pro base consumer. So contractors, people who are actually doing home improvement are shopping at Home Depot, and they aren't experiencing the same kind of discretionary spending reduction that general consumers and, pro DIY or DIY customers are experiencing.
Okay. Did your team want to add to that, or?
I think
No, I
something.
think-
Oh, go ahead, Chris.
No, you please.
Okay. I think something else to consider with that is that Home Depot is definitely the stronger, and the pro segment does have quite a weight on its long-term outlook in terms of keeping that stability. So if Lowe's has much more discretionary spending through its DIY customers, the pro customers are very consistent. With that, that is also a more short-term outlook. I think in the long term, Home Depot is going to remain very strong, and the industry as a whole will weather this storm.
Okay. All right. Well, again, thank you, Home Depot team, and thank you, Planet Fitness, for asking your questions. So we're going to go next to Planet Fitness. Just kind of seem to be going down the order. So they will be our next team to present. And Qualcomm will be their investment committee. And at the end of this presentation, we're going to take a 10-minute break.
Okay, John, are you ready? Okay, awesome.
All right. Are you ready to go, Planet Fitness?
I believe so. We should be good to start.
All right. I'm going to go ahead and turn on the clock. The floor is yours.
All right. Hello, everybody. Welcome. We're group 2. It's Tarun, John, Peter, and myself, Will. Our evaluation was done on Planet Fitness. The bottom line up front is that our target price is $52.79 based on our analysis, and that comes with a sell recommendation. We'll get into the rationale as we continue with the brief. This quick table of contents, we're going to go over EIC, historical analysis, multiples, and then our valuation model, followed by any Q&A. First, the EIC. So the first thing that we looked at was the economy, and we looked at our industry relative to Planet Fitness. And so the industry given to us by Bloomberg included a mix of fitness companies like Planet Fitness, Lifetime, Exponential Fitness, as well as a few more of the entertainment variety, including Dave & Buster's, Cedar Fair. All these together, we took and looked at the industry beta and arrived at an industry beta of about 1.23. This seemed to indicate to us that for every 1% change in the market, we expect to see a reflection in the same direction of about 1.23% from the industry. And so there's a high degree of correlation between changes in the overall economy and changes in this industry. Next slide, please. We also took a look at the spread for the industry between the ROIC and the WACC. And for the industry as a whole, it averages out to a negative spread of negative 0.96%. We took a look at what considerations were affecting this value on the next slide. So here we did a Porter's 5 forces analysis, taking a look at competition, barriers to entry, supplier power, customer power, and threat of substitutes. When we looked at competition, currently we rated it as high. We believe there's a high number of fitness clubs that are competing for different membership and customer time, and brand recognition in the industry is very key to high levels of revenue. Looking forward in the next 5 years, we don't expect there to be a lot of change in this level of competition. There will continue to be steep competition, particularly around price and different membership rates. Barriers to entry in the industry remain low. The cost entry is very low due to the limited number of resources that are required and the fact that it's very easy to open up and offer a membership rate and get going. And we don't expect that to change going forward. New entrants will probably come and go freely into the industry going forward. From a supplier point of view, we rate it as low to medium. Some suppliers benefit from having specialized equipment offerings for particular types of gyms, but most of them are competing to produce very similar offerings, and that creates competitions between the suppliers, which comes to the benefit of members of the industry. Going forward, we believe that it will continue to stay where it is at a low to medium level because the required industry equipment for our industry is unlikely to see significant changes in the next 5 years. Customer power is high because customers have a high variety of options when it comes to their fitness of choice and the price point that they want to come in at. And that's unlikely to change as well. Customers are likely to be able to go around, decide on what's the best fit for their needs and shop around for the best offering that they have. And that also explains why there's a high threat of substitutes. There's lots of alternatives where folks can go for their health and recreation, including recreation leagues, working out at home, community clubs, and these communities will continue to be prevalent in the U.S. and provide a variety of effective substitutes, particularly going forward. Next slide. Taking a look at Planet Fitness itself, Planet Fitness has a competitive advantage based on its positive spread between ROIC and its WACC at 1.99%. However, we feel that in the next 5 years, we're going to see a shrinking of this competitive advantage for Planet Fitness. Some of the supporting evidence for this prediction includes that Planet Fitness is facing some decreased site availability in the aftermath of COVID-19, which has reduced the number of store openings that they're able to do over the next 5 years. And this is compounded by increased store opening timelines. It's taking longer and it's costing more. Existing Planet Fitness stores are also likely to see a requirement for increased cash requirements due to a number of re-equips and remodels that they have scheduled in the next few years. And Planet Fitness currently faces a challenge with its price point of $10, which is heavily baked into their marketing, which might limit their ability to flex those prices in the face of shifting costs down the line. Finally, one last point that we felt would squeeze on the competitive advantage of Planet Fitness is that click-to-cancel regulations are on the rise in the US, and they're threatening Planet Fitness's ability to maintain members. Currently, Planet Fitness, you have to go in, there's a whole process to get rid of your membership. These regulations allow members to come in, click a button on the internet, cancel their subscription right away, and that can hurt Planet Fitness's current business model. Next slide. I'll now hand it off to Peter for the historical analysis.
All right, here for the historical analysis, next slide here, perfect. So the Planet Fitness ROIC tree is one of the more discouraging outlooks that we've seen throughout the numerous companies that we've evaluated over the semester, both with goodwill and even more bleak without goodwill. They have an extraordinarily poor ROIC that sees them dropping almost 67% over 5 years, from 26.7% in 2018 to 8.8% in 2022. This is driven by poor pre-tax operations, including an operating margin that saw them going from making 32 cents for every dollar down to below 25 cents for every dollar. One positive was a strong increase in gross margins that saw them almost making 2 more cents for every dollar purchase. However, it was more than negatively offset by their poor SG&A and depreciation. An increase of 43% for SG&A and an astronomical increase of 115% in depreciation. The balance sheet side of their ROIC tree wasn't any more promising, with a tax rate that went from 21.7% in 2018 to 31.3% in 2022. Planet Fitness also had a poor invested capital sales that saw them going from spending 94 cents of investment in their balance sheet to drive $1 of sales in operations in 2018, increased spending almost $2 to almost $2 to drive $1 of sales in 2022. In addition, Planet Fitness saw an increase in intangible assets, which includes goodwill and acquisitions. They also saw decreases in operating working capital and increased costs in PP&E. Overall, very poor income statement and balance sheet that contributed to a poor outlook on their ROIC. Next slide, please. And here we just kind of showed as I mentioned, the tree's even worse without acquisitions and goodwill. So next slide, please. So Planet Fitness's CFI model was a little more promising, as they saw sizable growth in NOPLAT from 2020 to 2022, notably from that large dip that gyms around the world took in 2020 at the height of the COVID pandemic. From 2018 to 2022, Planet Fitness also saw an increase of over 40 million in gross cash flow, all tied to their strong revenue growth. Planet Fitness had very high depreciation each year. Not a surprise they had so much gym equipment in their gyms. And as mentioned, they had strong revenue growth that saw them go from 20.2% in 2019 to 59.6% in 2022, including up from the COVID dip that saw them at negative 41%. Planet Fitness had a large increase in capital expenditures. Saw them go up from 66.3 million in 2018 to 455.8 million in 2022. Notably, they have negative 846 million in free cash flow ending in 2022, down from a positive cash flow of 173 million the year before. In terms of debt, they have 396 million in new debt and have consistently had an increase in debt all 5 years. Their lowest year is 2021 with 22 million in new debt. They also have pretty small dividends, but they increased from 21 to 2022. And but these are still down from their 5-year high in 2018. And with that, I'll pass it off to the multiples.
All right, cool. Thank you. Go to the next slide. So we'll do a brief multiples analysis of Planet Fitness compared to Lifetime Holdings, otherwise known as Lifetime Fitness, and Exponential Fitness, another competitor in the industry. And so overall, we see that Planet Fitness is trading at a premium to Exponential Fitness and a discount to Lifetime with the PE and EV to EBIT multiples. They're trading at a premium to both Exponential Fitness and Lifetime with the EV to sales multiple. Looking a little bit further at the numbers, we see for the PE multiple, Planet Fitness at 23.82, premium to Exponential at 17.13, but a discount to Lifetime at 24.89. EV to EBIT, again, Planet's at 21.91, premium to Exponential at 15.88, a discount to Lifetime at 23.23, and EV to sales, Planet is at 6.3, premium to Exponential Fitness, which is at 4.35, and a premium to Lifetime at 2.94, which we'll touch on in just a second here. Couple of quick notes as well. Exponential Fitness effective tax rate, we estimated using the pre-tax profit and adjusted net income from Bloomberg, as there was not guidance on this particular tax rate. Also, the Exponential Fitness return on equity, we estimated with the modified DuPont formula, basically multiplying the return on assets, which was given by the leverage ratio, which we also had. Looking a little bit more granularly at the multiples, the PE multiple, despite the lower growth rate, Planet barely trades at a discount to Lifetime Holdings with a spread of about 1 due to Planet's large ROE spread of approximately 85% and trades at a significant premium to Exponential Fitness due largely to their Exponential Fitness's low net income estimate of 56 million. Despite having a actual positive ROE spread, which, as you can see, is uncommon, of about 0.4%. EV to EBIT multiple, Planet trades at a premium to Exponential Fitness due to the positive ROIC spread and a lower relative growth rate, but at a discount to Lifetime Holdings. And this is interesting. This implies that the market values Planet significantly over Lifetime with respect to sales, but values Lifetime slightly over Planet with respect to each dollar of EBIT. And the Lifetime Holding negative growth rate is the only value that mathematically allows the EV to EBIT value to be the actual of 23.23 with such a large negative ROIC to WACC spread. And we were talking about this, and one way to interpret this is the market potentially indicating that Lifetime is overvalued because the large negative 33.96% long-term growth implies shrinkage over time for the current EV to EBIT ratio to mathematically hold. So yeah, that is that. And I'll pass that off to our next group member to go over the valuation.
All right, now I'll get into our valuation with our as is, bear, bull, and target. So for our as-is model, we have the share price for Planet at $60.82. We had to do a little bit of manipulation in order to properly model the share price. For revenue and EBITDA data on Bloomberg, the data only went to 2026. So we changed the continuing value year to 2027 throughout our entire model. Most of the models we did during the course used 2028 as continuing value year. So it took a little bit extra work to get to this point. For the EBIT margin, we found an estimate of 28.8% in 2024 and 29.7% in 2025. So we settled on 29.3%, which is the average of the two, as our EBIT margin in perpetuity. Over the years 2024, 2025, and 2026, we found an estimated EBITDA margin of 41.6, 42.1, and 44.6 respectively. Since we used 29.3 as our EBIT margin and we kept tax rate and depreciation constant, we worked backwards to calculate the EBITDA margin. Feeling that the 2026 EBITDA margin was high, 42.5 as our EBITDA margin in perpetuity made sense. We used the WACC straight from Bloomberg in our as-is calculation, and our model gave us a continuing value year no plot of $354.8 million and an ROIC of 15.5%. Our forecast for the continuing growth rate is 6.74%, and we use GoalSeek to work backwards for this number. So on our ratio sheet, you can see that the EBITDA for 2024, 2025, and 2026 are reflected as from the assumption sheet. But in our continuing value year, 2027, we use the 42.5% that we just discussed and an EBIT margin of 29.3. In this model, we kept the tax rate constant and depreciation and amortization constant as well. We also kept the revenue growth rate constant in the continuing value year, given that in our EIC analysis, it was safe to assume that revenue growth would not fluctuate too much. And now on to our bull model. Our bull model has a share price of $83.54. This was done through three main factors: increasing the revenue growth rate, increasing the EBITDA, and increasing the long-term growth rate. In 2027, we increased the revenue growth rate to 13%. If Planet Fitness is able to continue to expand and possibly deviate from their $10 a month marketing tactic, this could cause an increase in revenue. Additionally, uncertainty around click-to-cancel legislation could play out in Planet Fitness's favor. It's said that the gym's favorite member is one who pays every month, but never shows up. So those members who may have more difficulty canceling their membership or even just forgot about it do contribute to revenue. We also increased the EBITDA from 40 to 45% from 2023 to 2027 for the same factors as mentioned previously, as well as a significant uptick in membership signups post-COVID. In recent years, health and fitness have become increasingly popular as physical and mental health awareness has risen. Lastly, we increased the long-term growth rate from 6.74% to 7%. All of these factors mentioned previously combined into a positive outlook for future growth for Planet Fitness. As people look to get in shape, Planet Fitness offers a reliable and cost-effective option. And for our bear model, we estimated the share price to be $40. This was done through a decrease in revenue growth rate, a decrease in the EBITDA, and a decrease in the long-term growth rate. In 2027, we decreased the revenue growth rate to 12%. Due to a slow return to brick and mortar shops, gyms specifically, we estimated that revenue growth would not meet expected levels in 2027. Additionally, if the click-to-cancel legislation is successful, we expect a drop in revenue. We also decreased EBITDA to 40% from 2023 to 2027 for the same factors as mentioned previously, as well as threatening substitute products. Many tech companies and other businesses have pushed into the fitness space, offering alternatives to traditional brick and mortar gyms, such as Apple Fitness with their Apple Plus subscription, Peloton with their offers, their at-home spin equipment with memberships, and ClassPass, which offers access to in-person fitness classes such as gyms like Core Power Yoga, Orange Theory, and F45. Ease of use and convenience have become increasingly important to customers, and these alternatives are creeping into Planet Fitness's market share. Lastly, we decreased the long-term growth rate from 6.74% to 6.3%. All of these factors mentioned previously combined into a gloomy outlook for the future growth prospects for Planet Fitness. As people look to get in shape, there are a handful of other low-cost options that may be more attractive than Planet Fitness. And then for our target share price, we have a target share price of $52.79. And in this model, we only decreased the long-term growth rate to 6.4%. This was due to factors mentioned in our EIC analysis, as well as the bull and bear models. It's increasingly difficult to estimate factors such as revenue growth, EBITDA, and operating margin. But we can say with more certainty that we believe that the long-term growth rate will be lower than what our as-is model predicts. Increasing competition from alternative health and fitness platforms, along with more power to consumers through legislation and necessary rehabilitation of current facilities, indicates less future growth for Planet Fitness. Just to sum it all up, so our EIC analysis has a beta of 1.23% and a negative industry spread of -1%, yet positive spread for Planet Fitness at 2%. Our as-is model is at $60.82 with a long-term growth rate of 6.74%. Our bull model is at $83.54, and we increased the long-term growth rate, EBITDA, and revenue growth rate. And the bear is essentially the inverse to that. And then for our target at $52.79, we decreased the long-term growth rate to 6.4%. And with that, we will open up the floor to questions.
All right, Qualcomm, you're the investment committee. You're on
Yeah,
the floor.
Yes, good job. So I had a question on your taxes. I think I didn't. I saw in your ROIC tree that the taxes vary significantly over the 5 years. Like you had values like 30%, 24, or like -4, or something like that. Did you look into what caused this and how you use that for your target model?
So on our Bloomberg guidance, it was at 26% in the future. And just given that it was fluctuating so much over the past few years, especially with COVID, we decided just to use the guidance in perpetuity or for the next 4 years of our model. I'm not sure if Pete has anything to add to that, but that's essentially what we came down to the conclusion of.
No, the only thing I was going to add was obviously the 2020 number, which is because gyms all got breaks that year. So that was all I was going to add. That's why there's the big dramatic differences.
All right, thanks.
Question on this one. For the PPE, is going up. Was there a reason for that?
Yeah, it's hard to really think about that. And from my perspective here, I would assume that if they're trying to, I guess, expand or they're replacing equipment, this number would increase. I think that was mentioned in our EIC analysis that they were trying to refurbish gyms and expand.
Right. To add on to John's point, part of Planet Fitness's strategy has been to expand the number of gyms it has nationwide for the last several years. So you're probably seeing in this ROIC analysis some of the execution of that strategy and what they're aiming to do moving forward.
A follow-up to the question: Are these stores owned by Planet Fitness or these franchisee stores? And I was the other question was is the $10 business model, is that the only way they generate revenue? I think they have a different other segments where they generate more revenue.
Yeah, as far as I know, they do own all of their equipment. I'm not 100% sure how the background in gyms work, if you can lease equipment out from companies who make gym equipment. But to speak to your $10 a month deal, I believe that's the only thing that they have. I think it's just a $10 flat rate. There's no Planet Fitness premium gym, but there's probably add-ons that you can do. Like you could probably book personal training and other things like that. But I doubt that that has really any dent into their revenue, just because people take a cut out of that.
Jack, just real quick, they do have a couple of different membership tiers, but it does seem like their overall strategy is more high volume, low cost sales of the $10 membership, because that is the one that is promoted. But yes, they do have different tiers available.
Can you guys talk a little bit about their productivity and what kind of technology they're looking to implement and trying to bring that number down from, what was it, $1.90 for every dollar they generate? Yeah, in 2022 it was $1.90. Can you talk a little bit about what kind of technologies they have or how they're spending that money, I suppose?
Yeah, I'm gonna think that if you look into their property, plant, and equipment, that's really what's driving their invested capital over sales. So back in 2018, they were spending less than $1 to generate $1 of sales. But when they're replacing all of this equipment and trying to expand into new locations, they're spending a good chunk of capital in order to make a return. So I'm not sure if there's any new technologies really that the gym is using. Usually just fundamental plates and workout machines. But I think it's just expansion that's really making that invested capital to sales number increase.
Can I ask a question on the multiples? Do you mind going to the multiples slide? So Planet Fitness seems to have a pretty big discrepancy between their return on equity and their return on invested capital, 96 to 11.5. Can you talk a little bit through that and kind of how you came to those numbers, or how you kind of
Yeah, no, absolutely. So the short answer is it's from the Bloomberg screenshots, but the longer answer is we did think about it. If you looked, so this is the forward-looking expected ROE for 2024. But if you look at 2023, 2022, it does kind of fly all over the place. I forget the exact numbers, but I believe it was a smaller positive number, and then it went to -4, and then shot up to 96%. So the assumption, I guess, is that they're just betting on big returns from these expansions in the next year or so. But yeah, that is something that is going to require further investigation, is the wild change in the expected ROE. And if anyone wants to add to that.
Just a question, in your historicals, did you see the impact of COVID? I know a lot of the gyms were closed. So did you see an impact of that?
We did, like, just to, I guess, continuing from where I was currently, or where I was previously talking, the ROE, I believe, like, the negative year was the COVID year, and I can pass it on to my other group members to discuss some of the other figures. But yeah, you do see a pretty clear negative trend in the 2019-2020 reports. Pete, did you want to say something? I don't know.
Yeah, I was going to add, not even just in the ROIC tree, but everywhere. It seems like over our 5 years, a lot of it will be like 2018, 2019, an increase, and just a giant dip, and then back up. Pretty much correlates all 5 years with the gyms. 2020 just saw a dip in almost all our categories. So
does that explain the wide fluctuation in the tax rate that's reflected in the historical analysis? I mean, it's all over the place, but it looks to me like, I mean, I was trying to figure that out. And so I think you just offered the explanation for why that tax rate would jump all over the place. I mean, it was somewhat consistent, but that 2020 year is, you compare it to everything else, it's just off the charts.
Yeah, I would say it seems like COVID just shocked the whole industry and kind of threw everything into disarray. And at a very bird's eye view of things, like, this is Planet Fitness's attempt to kind of recuperate in the next 5 years. And it seems like the competitors are coming up with their own strategies to do the same. So
they basically were operating at a giant loss.
Yeah.
And why would it, yeah, I think somebody might have asked this question before, but why did it go up to 31%? It's like, why wouldn't it remain at 21? What are they doing differently?
Well, based on our discussion of taking heavy losses, you're probably seeing less offset from previous losses going forward. Arriving back to a more standard tax rate as we come out of COVID.
All right, thank you, investment committee, for asking those questions, and thank you, Planet Fitness. I was curious my own self. You made an offhand comment somewhere in the presentation, but like, how much money do they make from their subscriptions when people just don't show up but keep paying? It seems like a very important part of their business model. And you almost made a joking comment about that, but I don't know if you had any thoughts on that, the context of your evaluation.
Yeah, there really isn't any data to support that, but I mean, what my thought is, like, a gym's favorite member is the one who doesn't show up, who doesn't cause them to have to turn the lights on, who causes them not to run the water and keep their facilities up. So they're just making free profit or free revenue off of those people.
Yeah.
I don't really have like an actual number on that, but I'm sure Planet Fitness is trying to keep that buried somewhere.
Yeah,
I'm sure there's plenty of internal reporting on that exact figure.
I'm just curious. I think we
Yeah,
all
yeah.
kind of hinting at the sense that it's probably
Right.
fairly
Yep.
for them.
Yeah, so
Yes.
the legislation does pose a threat there for sure.
So, all right. Well, again, good job. Good job, all the team so far. Two quick comments before we take our break. You know, Home Depot had a really good example of why ROEs can get distorted. When they talked about how they bought back so much stock, their equity went negative, and how that influences multiple analysis. And then just one thing, Planet Fitness, you know, perpetuities, your G can't be higher than your R. So I know in a couple of circumstances you actually had that. So that also makes your multiples a little bit harder to deal with in that situation. So, but in any event, let's take a break. Let's come back at quarter after, and we're going to kick off. Qualcomm will be our fourth team to present for the night. So I'm going to go ahead and pause the recording until we're back at 8:15. All right, welcome back from our break. The recording is on. David, you had a comment in the chat said Google says 60%. What were you referring to?
I think that was the memberships that people don't use at Planet Fitness.
Oh, you looked it up? Or he looked it up on Google?
Oh, I'm speaking for David because I think that comment was when I was speaking about it in the Q&A.
Yeah, if that's, you know, remotely like the actual number, that's kind of scary. But regardless, thank you for finding that information if that's the case. So Qualcomm, is your team ready?
Yes.
And Tesla, again, you're going to be their investment committee at the end of the presentation. So if you're ready, your guys are on the clock.
All right, hope everyone took a nice break. Our team analyzed Qualcomm, which is a key player in the semiconductor industry. So we have our teammates here, Ashish, Moss, Julian, Carlos, Mike, and myself, Gabby. Our recommendation is a target price of 119 for a hold strategy. And we're going to walk you through how we come up with this through that EIC analysis, the historical analysis, the multiple comparing relatable companies, and then evaluation forecast. And so with that, we'll start off with the EIC.
Good evening, all. So today I'll be going through the two portions of the EIC analysis, which is the economy and the industry. So the beta for Qualcomm is 1.36. The beta for semiconductor industry itself is 1.69. Since both the Qualcomm and the semiconductor industry have a beta of more than 1, it's relatively very sensitive to the economy. Next slide, please. Okay. On the industry side, the ROIC for the semiconductor industry is roughly around 15%, with a positive spread of 2.69. And the ROIC for Qualcomm is roughly around 27% with a positive spread of 17%. Indicating it's a comparatively, it's a very, very attractive industry to invest in. The majority of the companies in the industry have a high ROIC and a positive spread. Some of the key players in the industry is MediaTek, NVIDIA, Texas Instruments, Broadcom, Intel, and very recently there was an IPO that was announced for ARM by SoftBank. So I think that's ARM would be one of the key players. I'll pass over to Maz.
All right. So yeah, I will be going over the five forces, Porter's five forces, starting with the competitive rivalry. So looking at 2023, I think for both 2023 and 2028, the competition is going to be high. That's because you have to be very innovative in this industry to remain in business. If you don't innovate, you're going to be out of business. Moving on to a threat of new entrants. Right now, it's low because to get into this industry, you need high capital and high-tech labor. Medium term, I think in the Chinese market, there's interest from government funding. So government is interested in investing. So there will be a medium-term threat there. In terms of buyer power, right now it's low, but we see in 2028 it could be medium because if other buyers start developing their own chips like Apple, that could impact Qualcomm. In terms of supplier power, I think it's going to remain medium because Qualcomm depends on limited number of manufacturers to manufacture their chips. In terms of substitute, I think right now it's low, but medium term, especially in the Chinese market, you could have low-cost substitute for the low-cost phone in that market. Next slide. So Qualcomm was founded in 1985. It has 51,000 employees, revenue of 44 billion, and it has 3 business segments. Most of the revenue is coming from the CDMA business unit. Qualcomm has a competitive advantage in the industry with a positive spread of 17%, market capitalization of 130 billion, and currently is dominating the cell phone Android industry. Next, we'll go over the historical analysis.
Yeah, so with that, the ROIC tree, to start us off on the legend. So we have green is a good trend, red is a bad trend. And we did a 5-year analysis, but you'll notice 2018 was a very odd year for Qualcomm. So a couple of reasons. So they had US deferred tax liability from 2017, and that's to take advantage of the Tax Cuts and Jobs Act. They also had to pay a lot of termination fees to NXP, which is a company they were going to acquire, but they didn't go through with it. And then they also had to pay a lot of legal fines and settlements with a dispute with Apple. And so because of that, we decided to also look at the 4-year. And for my analysis, I'll talk about that. And so with that, the keynote, so ROIC from 2019, it goes from 42% to 58%, which results in a positive or good trend of 37 ROIC. I already talked a little bit about taxes, but they decreased significantly to 13%, which we'll later on use. In terms of the primary levels, we'll start off with the operating margin. And so with operating margin, they generated 31 cents of operating margin for a dollar of sales in 2019 versus 35 cents, which is an increase of 13%. And in terms of their invested capital, they're less productive. So they're spending 53 cents in 2022 versus 41 in 2019, which equates to 28% on the 4-year trend. So if we look at the secondary levels, we can see here what's causing those. And starting off with operating margin, again, positive 13% is cost mainly on the gross margin. You'll see here they're fairly consistent around 60 cents. 2019 was an odd year. They had really good successful year, but overall they're fairly consistent throughout those 5 to 4 year trends. So really what contributes is it's the savings. They're able to decrease costs on SG&A. You can see here they go from 33 cents to about 22, and they're able to decrease costs. And this is going to be key for our target models as well as our bull. In terms of depreciation, they decrease some as well. So their assets are losing less money, and that's what contributes to the good trend. Looking at invested capital, we're looking at the biggest contributor to the 28% increase here is it's really working capital. So working capital is hurting them. Basically, they're worsening their collection period and perhaps paying suppliers quicker. And so you see there they're increasing to 300%, which is bad. In terms of PPE, very fairly consistent, so not much to comment there. And then intangibles. Intangibles does help them, but it's not enough to offset the working capital. And so if we look at the next slide on taking goodwill out, as a reminder, goodwill is excess cash that you pay for an acquisition. So you can see that the ROIC numbers are higher, like they're on the 200%, 200%. But overall, the trend worsens because there's a downward trend on goodwill, like we saw in the previous slide. It was positive on the invested capital there. So looking now at the CFI, I'll hand it off to Carlos.
Thank you, Gabby. Taking a look at Qualcomm's 5-year CFI, we calculated that Qualcomm had an average CapEx depreciation ratio of 134% with a reinvestment rate of 40%. We also saw that the company had achieved cumulative free cash flow of 43.8 billion. Over the same period, they had earned a cumulative gain of 23.5 billion from after-tax income. They spent excess cash in the amount of 31.4 billion and acquired 1.2 billion in non-operating assets and liabilities. This brought the cumulative cash flow available to investors to 73.9 billion. So now we'll take a look at how they kind of spent this money, spent the CFI. They start off by spending 30.6 billion on interest for debt. They paid off 5.7 billion in loans and debt. They, with a significant portion of that coming in 2018 in the amount of 5.5 billion. Furthermore, they spent 15.5 billion by distributing to shareholders in the form of dividends. Another 1.8 billion was gained from reissuing shares. And then 33.3 was spent on stock repurchases. So this totaled in approximately 47 billion returned to stockholders over that 5-year period. Additionally, there was another 9.5 that was spent on other adjustments to equity. As Gabby mentioned, 2018 was a really odd year. So some of the things that we kind of point out is that in that year alone, they had 58.6 billion CFI. And then that year, they spent 3.5 billion to pay dividends. And then another 22.6 billion was allocated in share buybacks. That was as a result to the terminating the merger with NXP. Next, I'll hand it off to Julian, who will take us through multiple analysis.
Thanks, Carlos. So yeah, I'm going to go through a comparative multiple analysis between Qualcomm and some of its competitors in the industry, NVIDIA and Intel. So the first ratio we're going to look at is the price to earnings ratio. We can see Qualcomm had a ratio during our analysis period of about 12.8. And comparing that with NVIDIA, which had about a 36.6, that's about a 3x premium for the PE ratio of NVIDIA over Qualcomm. Primary driver of this is really the expected growth in net income for NVIDIA being substantially higher than that for Qualcomm. 12.2% absolutely trumps Qualcomm's 4.6%. What also contributed to this was a enhanced or better spread for NVIDIA, or expected spread for NVIDIA. The ROE was 45% versus Qualcomm's 35%, and the cost of equity actually detracted a little bit from NVIDIA, but that was more than compensated for by the spread between the ROE and the cost of equity. Moving on to Intel, a PE ratio of 19.4, which is again trading at a PE premium to Qualcomm. Again, main driver for this is higher expected growth in net income for Intel of about 7.5%. What detracted from Intel's PE ratio compared to Qualcomm was actually its spread. So its spread is worse at about 9.3% compared to Qualcomm's 23.6%. Its cost of equity being lower helped it out a little bit, but its expected return on equity was much lower than that of Qualcomm. So that detracted a bit, but still had a higher PE than Qualcomm. Next, we'll look at EV to EBIT ratio. So Qualcomm's EV to EBIT ratio is about 11.5 for the analysis period. Again, comparing with NVIDIA, it far outperforms it at about a 33. So about, again, a 3x premium compared to Qualcomm. And again, similarly driven by NVIDIA's expected growth in perpetuity of 12.1% versus Qualcomm's 4.2. Effective tax rate equal between the two, so no difference there. And again, the spread between the two helped NVIDIA's case there with a 29% spread between operating return on invested capital and the weighted average cost of capital versus Qualcomm's 21.3%. Looking at Intel, trading at about a 2x premium for EV to EBIT ratio compared to Qualcomm, 22 versus 11.5. Again, mainly driven by Intel's expected growth in perpetuity of 7.4, being much higher than Qualcomm's. They had a little bit of help from a lower expected effective tax rate. And again, they were actually harmed or detracted from their outperformance by the lower spread between their operating ROIC and their weighted average cost of capital. Finally, we'll look at EV to sales ratio. Qualcomm had a 3.6 for the analysis period. And again, NVIDIA far outperformed Qualcomm. Main drivers of this were a much higher estimated operating margin at 53% compared to Qualcomm's 32%. And a much more impressive productivity. They spent, 94 cents in invested capital for every dollar of sales, whereas Qualcomm spent $1.17 for every dollar of sales. Looking at Intel, this is actually where on this ratio where Qualcomm actually outperforms one of its peers. Intel had a 2.72 EV to sales ratio, and main drivers of this again are much lower operating margin at 12 versus Qualcomm's 32%. And it was less productive. It had more invested more capital to generate a dollar of sales at $1.40 compared to Qualcomm's $1.17.
So thank you, Julian. Next, I'll talk a little bit about how we developed our as-is model. So if you can go to the next page. Thank you. Through using guidance and Bloomberg, we were able to determine 10.7 as our weighted average cost of capital. The information provided also stated that there were 1.1 billion shares outstanding, current share price of $116.57. And we use this information to solve for the continuing value of 3.5, growth value of 3.5%. Next slide. Thank you. So in terms of forecasting for the revenue growth rate in 2028, we essentially used the previous year's value of 4.7 for EBITDA. The years 2023 to 2027 was pulled from the Bloomberg, and we used an effective tax rate from the guidance of about 15%. So that results in the as-is price of $116.57. Thank you. And now Mike will be taking us through our bull and bear forecasts.
Thanks, Carlos. So the good news for Qualcomm is they've got an opportunity for growth through product diversification, specifically their automotive and IoT lines of business. In the automotive line of business, they're expected to leverage their smartphone technology to drive 30% growth annually through 2025. Their technology includes 5G connectivity, low power chip technology. In IoT, which is expected to just utterly explode where chips are going to end up in all of our devices at home. They are very, very well positioned with their technology. The issue that they're going to have to confront is basically global macro conditions tempering the opportunity there. Nonetheless, expected to grow that line of business 10% annually through 2025. The main issue that's holding them back, of course, is that this is not their core business. The core business, handsets, wireless CDMA technologies, that's expected to be flat because of the global macroeconomic conditions. The sluggish demand for smartphones basically is causing people, the people are holding onto their cell phones longer. The refresh cycles are take longer, and so as a consequence, given the flat prospects for their main lines, that it's where we expect that there's going to be some growth, but it's not going to be robust. There is likelihood that they're going to increase, they'll decrease their SG&A. In the last year, they were able to decrease SG&A by 5%, enhancing their EBITDA margin. We expect this to continue. We also expect tax rates to decline from 15 to 14%. We get this from JP Morgan, which is in a better position to assess that than we are. So in sum, given the description of the growth prospects tempered by flat growth in their flat business in their main product lines, we expect their revenue growth to increase at about 4.5%. And so you can see those numbers here reflected in our chart. They're highlighted. All of these numbers basically get us to a model share price, bull price of $134.65, which represents 13.4% increase over the current price. Next slide, please. The bear forecast, again, it highlights the stagnant cell phone market with the worsening macroeconomic outlook. In particular, they're exposed in China. It's a key market for them. And you add in the potential for a trade war risk. Former President Trump, even right now, is talking about a 10% tariff, which would really affect Qualcomm in a very terrible way because they're so exposed in China. In addition, OEMs are transitioning from Qualcomm chips to their own proprietary chips, Apple and Huawei in particular. This could create some risk for Qualcomm. And as you saw in one of the earlier slides, roughly 35% of Qualcomm's revenue comes from licensing their patents, and those patents have come under increasing litigation and scrutiny. There are disputes currently pending in China, Taiwan, Korea, and Europe, and depending on the outcome of those cases, if they got lower royalty rates, it could dramatically affect a meaningful portion of their revenue stream. Qualcomm's going nowhere. They are so dominant in the handset market. But nonetheless, we're lowering for our bear forecast, their growth rate progressively to 2.5%. And if the cost cuts of SG&A don't materialize, EBITDA could remain flat. That's all reflected in this Excel spreadsheet right here, this model. Ultimately, the numbers show a bear price of $100.21, which would be a decrease of 16.3% from the current price. I'll hand over to Gabby to talk about the target.
Yeah, so to summarize and to finish it off, our target scenario is a hold. As we mentioned, they're able to cut costs, and they've proven that in the past, as we've seen in their ROIC models. We kept the growth as is based on the competitors that they have, so we kept it at 3.5%. As we discussed, some of the costs materialized in an increase of EBITDA of about 0.5. And lastly, the tax, we kept it at 14, again, based on historicals at 13 in the past 2 years, and JP Morgan, we thought that was good. And so overall, strategies hold, target price of 119, which is about 3% higher or so from when we analyzed this. And so we'll take any questions. Thank you for your time.
Great, thank you, Qualcomm. And Tesla, you're the investment committee for Qualcomm.
Hi. So the first question that I had was, I guess, since you have the hold opinion, what exactly, and I know that, over the last 6 months or 8 months, Qualcomm stock has come down substantially. I guess what in the data or research or anything that you guys saw made you decide that it was going to level off kind of going forwards, and that the price that it's at now is just with the layoffs and everything that they've been kind of having. But yeah, I guess, was there anything in particular that you noticed that made you think that they're going to kind of stabilize?
Yeah, I can touch
Well, I
on
mean,
it and then
go ahead, Gabby.
I was gonna
Go
say
ahead, Gabby.
I'm gonna hand it off to Michael because he'll probably be better. But I would say just again, handsets or revenue is flat, and that's the majority. Like Mike mentioned, 30+%. And like Julian saw in the multiples with comparing companies, Nvidia, and it's a tough industry. So it's attractive, but there's a lot of competition. So that's why we weren't as bull as we should. And Mike, if you want to expand on the bull and bear.
Sure. So, with the layoffs reflect cost cuts in SG&A, as we talked, and it's tough news, and it makes for bad headlines. But they're a dominant player. They're particularly dominant with respect to Android devices, and that's not going anywhere. People still buy phones. The question becomes, are they just holding them a little bit longer? And the revenue projections really aren't dipping. The other thing that is really bullish for them is that there's going to be an iPhone launch, which is always good. So those come out every 2 years, and this is the year that they're going to have an iPhone launch. So it is true that some of the news hasn't been great, but I think it reflects the cost cutting measures that they've been undergoing, and from a economic performance standpoint, it's actually a positive.
Okay, thank you.
Hey, how's it going? My question is, during your industry analysis, you mentioned that Qualcomm's competitive advantage was a 17% spread. How do you think this will change in the next 5 years?
I think the spread. I think the industry will grow at a very gradual rate. I think a company like Qualcomm is investing in AI chips. I think that's the buzz right now in the industry. It's very similar to Nvidia. I think they are a very dominant player in the wireless chips industry, so they are investing in AI chips, and I think the spread will. I don't see it being really growing really the spread being very wide enough, but I think it'll be it'll probably just grow at a very constant rate, not much.
Yeah,
because even though there's an opportunity for growth investing in AI chips, but there are still a geopolitical and economic risk that basically just cuts those growth in the future.
Yeah, I'll also add, like, if you look at the industry, so they are the dominant player. They have a big market share. So unless another player kind of comes in, I would think they would probably have a very high spread going forward. So right now, we didn't see anything in the data to indicate any kind of decrease in their spread.
I had another question, kind of along those lines. Why is the growth so limited in Qualcomm compared to the competitors, NVIDIA and Intel?
Well, I mean, I can't speak to. I mean, clearly, NVIDIA is heavily. They're growing with respect to artificial intelligence. That's not a space in which Qualcomm participates. They're in a much more stable set of markets with handsets and wireless CDMA technology, and their growth is in automotive and IoT. There's real potential there, but it represents a much smaller percentage of their business. It's the focus of their chips. I'd have to go back and see where Intel is, but I don't actually think it's dramatically different. NVIDIA is an outlier because of their leadership in AI, but Qualcomm, they've got a mature business, and their product lines, their main product lines, are pretty much stagnant.
even though they are in the same industry, they design chips, two different chips in a sense. NVIDIA does a lot of data center chips, whereas Qualcomm does just the wireless chips. And since the whole overall economy is moving towards a very digital economy, there's more demand for data centers as compared to handheld device chips. So I think that's why you'll see a lot of growth in NVIDIA compared to Qualcomm. And Intel is just the design chips for PCs.
All right, anything else from Tesla?
One last question. Can you expand on the IoT connected technologies? What kind of devices do they feel that they're going to be able to use their chips in?
Sure. So the CDMA wireless technology, they'll put it into refrigerators, they'll put it into your lighting system and your air conditioner, and one of these super automated homes. At some point, everything's going to be connected, and they're well positioned to drop their wireless CDMA technology into those devices, and that's the idea. I mean, you have to pull up the slide here. It's a relatively small part of their business. It's only right now about 6.5 billion, and they're looking to grow it to about 8 billion. So this is not at the moment a game changer for them, but the expectation and hope is that as the economy heats up and people want to buy more refrigerators, it'll include Qualcomm chips.
I had one last question. So was there any indication that Qualcomm is, I know that you have it kind of noted right here, that there's potential for growth in the PC market, but does Qualcomm have the expertise from what you've seen to even be able to enter that market? Because, I mean, I have a desktop next to me. It has an NVIDIA chip in it. And, if you want the best performance, you put an Intel processor and an NVIDIA graphics card in your computer, and you're generally set for several years. Is Qualcomm looking to, I guess, break in and compete with AMD or something along those lines? Or do they just sort of lack that expertise since they're so specialized in mobile chipsets?
I think that's a great question. So the analyst reports make reference, both Bloomberg and JP Morgan make reference to these lines of business. But when I hunted around, I really couldn't find any meaningful support for the idea that they're going to go in whole hog and be any kind of competitor. And I think it's telling the fact that and we've got footnotes 3 and 5 on that line indicate it's Bloomberg and JP Morgan. Neither of them baked meaningful growth into their forecasts. So I think it's hopeful, and I describe it as potential for growth. But I think you nailed it. I don't think it's something we should be, from the standpoint of valuing Qualcomm right now, relying on in any way. They're not positioned in like they are with IoT and automotive.
Yeah, I think what I will add is in terms of technology, their competitive edge is low power. So that's where, if they have their chips in the cell phone, they do all that functionality while consuming very low power, right? So they won't be competitive in the PC industry where power is not an issue, right? So, so a lot of the technologies where you have batteries, I think that's where their chips are going to be competitive.
Okay, perfect. Thank you so much. And I certainly get that my computer has a kilowatt power source.
So good to know it can heat your house in the winter. But in any event, thank you, Qualcomm team. Good job. And thanks, Tesla. As a matter of fact, I think the question Tesla asked and Qualcomm answered is really just indicative of the importance of EIC, meaning, just to summarize what I think I heard and what you see is, if you paid attention today, NVIDIA or this week reported revenue 10 billion more than expected for the quarter. And they're just, booming, as we had talked about earlier in the semester, in the markets they're going to. Qualcomm's just not in those markets. I mean, they said it's like they're kind of tied a lot to Android phones and devices, and even the iPhone. And right now that the phones have slowed down dramatically, so too has Qualcomm, because they don't have the other types of chip categories to grow in that some of their peers do. So I think that was an interesting highlight throughout the presentation, just kind of seeing how that plays out. So thank you, Qualcomm. So one last team to go, Tesla. And their investment committee will be Disney.
All right.
So you guys ready, Tesla?
As we'll ever be.
Okay, you're on the clock.
Perfect. Thanks for coming, everybody. My name is Steven. I'm here with Joe, Audrey, and Isaiah. We're here to talk about Tesla, and we currently target them as a sell stock with a target at 186.39. So we can go to the next slide. And so looking at the overall economy, just for vehicle manufacturers, first off, we see that it's a relatively volatile sort of industry here. And we also see that Tesla is highly volatile compared to the economy as a whole. Currently the U.S. Federal Reserve interest rates between 5.25% and 5.5%. Although final sales of consumer goods are up, they are lower than previous quarters this year. If we go to the next slide. So the automotive industry as a whole, while there's a relatively low threat of entry with the sort of death of the internal combustion engine on the horizon, there is a lot of investment money being thrown at electric vehicles, since this is a big shakeup in a over 100-year-old industry. And so there is a lot of investment dollars for qualified firms. So the threat of entry is higher than it traditionally has been. Supplier-wise, suppliers have relatively low power in this industry now and going forward, unless a third-party company ends up creating, like the best battery that everybody has to use. But otherwise, most parts are relatively interchangeable, and they're relatively cheap there. Buyer power, with the new electric vehicles sort of pioneering this direct sales model, it does limit buyer power when directly going up to the firms in the industry. However, they do have every day, more and more substitutes that they could go to. On that topic, there are quite a few similar options available in this industry, and there is a relatively high amount of competition between those firms. And then if we want to continue on. So Tesla is well positioned. It's the market leader with 65% of the market. However, their EBIT margin recently has fallen more in line with that of their peers to 9.6% from 14.6% last year. They're also unfortunately positioned at a disadvantage with the delay of their Cybertruck going into the large US full-size truck market, which accounts for about 12% of vehicles sold in the US every year. And it's also missed its operating profit target for the last 4 straight quarters, which is of concern. However, on a positive but potentially a negative long term, it does own its own charging network, and which is great because it gives them a leverage to a utility function. However, it does raise concerns about antitrust suits being lobbied against the company farther down the line. Now I'm going to hand it off to Isaiah with the ROIC tree.
Thank you, Stephen. So looking at the third level of our tree and focusing in on operating margin, we see a steady increase from 0.18 all the way up until, or excuse me, 0.18 in 2018, all the way up into 0.16 in 2022, showing a positive trend for operating margin. And this is mainly driven by the invested capitals to sales here, which we see has gone down from 0.43 in 2018 to 0.27 in 2022. Moving up a level towards the cash tax rate, we see that there is a fluctuating tax rate all throughout 2018 to 2022, and it increased by 243%. However, when taking a look at 2018 and 2019, we see that there is a negative tax rate, and then in 2022 it sits at 25.3%. However, from that point on, it declines all the way down to 8.3% in 2022, which positively affects the ROIC. So moving on to the, yep, thank you. So with all of these key drivers, it's kind of clear to see that why Tesla's ROIC has increased from negative 4.4% in 2018 to 56.1% in 2022, given that all of these drivers have been moving in a positive trend. All right, moving on. Taking a look at the free cash flow, if we look at the fourth line down and take a look at the gross cash flow line, we see a steady increase from 1,490 in 2018 to 16,276, and this is indicating improved operating performance as the company is generating more cash flow from its operations each year. Moving down to the free cash flow, we see that in 2018 and 2019, there were negative free cash flows. However, there was a substantial increase in 2020 increasing from 2,607 in 2018 to 6,679 in 2022. Again, showing better efficiency in utilizing assets. Moving down towards the reinvestment rate, it started from a high of 280% in 2018 and declined to a low of 58% in 2022. And this kind of reflects the company's strategy towards reinvesting earnings back into the business. However, this also kind of signifies less investment and growth opportunities. And then moving on to debt and equity financing flows. We see that for debt, which is the second line down there, in 2018 and 2019, we see a negative in debt. However, in 2020 to 2022, we see an increase. And then additionally, in terms of equity, if we go down to the share issue line, we see that in 2020, there was a substantial amount of shares issued, 12,686 to be exact, and then reduced the following year to 707. This is kind of indicating a potential capital raising for more investments. And just to wrap everything up here, all of these trends that I've mentioned suggest a shift in Tesla's financing strategy, as well as possible expansion or restructuring efforts. So moving on here, and that's pretty much what is being displayed here. But now I'd like to pass it to Audrey to go over multiples.
Thank you. So Tesla is trading at a premium to both Ford and BMW. Here we're focusing on the yellow highlighted lines. We can see that they have a PE multiple of 50.37 compared to Ford at 6.47 and BMW at 6.07. And with an EV EBIT of 43.79 compared to Ford at 3.75 and BMW at 9.59. So why does Tesla have such a high multiple compared to Ford and BMW? This is because, as we've discussed, finding comparables is difficult, and they are more than just a traditional car company. With their advances in electric battery development and software for self-driving cars. Even though BMW and Ford are both have electric cars, Tesla is at the forefront, and we see that reflected in their multiple and their expected future growth. We actually found the same growth rate for Tesla for both the PE multiple and EV EBIT of 13.05%. And we wanted to note that for Ford's PE growth, we needed to assume a growth rate and solve for expected ROE as if we were to just solve for growth, it would have put it somewhere around negative 200%. And we didn't feel this accurately reflected their future growth. So we chose a growth rate of 1.5%, which gave Ford an expected ROE of 5.09% and a negative spread of 7.31. We felt this better reflected their current messaging, in which they are expecting losses in their EV business through 2026. And they are currently lowering their EV pricing and working on getting production up and running. They're then offsetting their losses with money from their combustion engine market, which is helping to drive their limited growth and therefore the growth of the 1.5%. And then we felt this was fairly consistent with their EV EBIT growth rate of 3.53% and the negative spread. And then here, focusing on the orange highlighted rows, we can see that the three have a fairly similar cost of equity, with Tesla even slightly higher here, and which could hurt their multiple, but with their expected ROE so much higher at 21%, and then with their spread and growth rate, their PE multiple skyrockets above Ford and BMW's, which both have a negative spread. So looking at their EV EBIT calculations, we see a similar story. Tesla's WACC is higher than the others at 13.77%. But again, they benefit from a high expected ROIC, which we calculated as a percent of equity. And since they are 99% equity, this came out to 20.79%. While Ford and BMW, again, both have a negative spread. So BMW does benefit from the lowest WACC at 7.1%, which they do need to keep as low as possible, because if this were any higher, their spread would be even worse and their EV EBIT would be even lower. And then here we are focusing on the green highlighted rows. And Tesla's EV to sales is at 5.9, almost 26 times higher than Ford at 0.22 and 6 times greater than BMW at 0.94. We can see that Tesla's operating margin is at 13.5%, which is higher than both Ford and BMW. 10% is considered fairly standard for an automaker, which we see with Ford and BMW, though Tesla has said that they are not focusing on their operating margin. So it's no surprise to see it this high, though we can see that their productivity is helping, as they are only spending 55 cents for every dollar of sales they generate, whereas Ford and BMW are spending $1.17 and $1.76 respectively. As capital structures can distort the PE, and capital structures for Tesla, Ford, and BMW are not very similar at all. Tesla's 99% equity, Ford is 29.5%, and BMW is 42.8%. EV EBIT may be our more reliable model to look at for comparison, though EV EBIT is better for more established companies, and Tesla could still be considered a fledgling compared to Ford and BMW. So some credit could be considered for both here. And I will turn it over to Joe.
Thank you, Audrey. So we'll get into the valuations now. As we can see that they have incredible growth. Their return on invested capital is 44% and growing at 12.1%. The revenue growth rate is expected to continue at 19.4% and stabilize long term at 18.6%. And taxes, we expect to level out at 15%. So just a couple of unique features to talk about with Tesla because they are very unique. We're talking about a company that year over year, over the last 5 years, has averaged 50% increase in revenue. They really are continuing to expand. They're selling vehicles with superior software, but they're also selling energy and infrastructure for that, connectors, partnerships with other manufacturers, home electricity hardware, getting into truckload ground shipping, and continuing to develop software technology to include autonomous driving. So it's much more of a tech company than a car company, which is probably some of the appeal of some of the investment. There is going to be continued competition entering the EV market. There's a price war emerging in Asia, and they will need to diversify to find more revenue to support this growth. So moving on to bull conditions, we're looking at it is so reliant on the economy, sales, so that a 1.96 beta is double the correlation of how the economy is doing. And with that, revenue increases we expect to continue to improve and stabilize long term at 21%. And that's because of the release of the Cybertruck, the Tesla Semi, and the upcoming economy version Model 2. Partnerships and expanding of the supercharging stations and new models will also result in a long-term EBITDA increase to stabilize at 19.5%. Taxes may also help, given the global warming concerns, that there may be more incentives from manufacturers and for consumers to transition to greener energy. Corporate growth rate with all these investments, we expect to increase their long-term growth to 12.1%. So we can do a little side-by-side analysis here of a quick snapshot to look at the differences between the current as is and the bull price of 305. And then moving on to bear conditions. In the economy, we expect inflation to continue, which will hamper growth some. Revenue is expected to decrease by 1.5% per year and long-term stabilize at 17.9%. EBITDA will decrease to 14.6% in 2023 and long-term to 17% because of the increased competition, high inventory, and potential price wars in multiple markets as more competition emerges on the EV automobile industry. We expect taxes to increase to get closer to the corporate rate. We estimated 16.5%. Long-term growth rate, given these conditions, will decrease to 11.9%. And then there's a side-by-side for the different values. And then we move to our target valuation, which is 186.39. And in the economy at this point, we're picturing mildly generally improving conditions, which isn't going to help revenue growth rate a ton. So we anticipate it to decrease and stabilize at 18%. EBITDA will decrease over the long term to 17% as they match production to the consumer needs, which is really the emerging problem with controlling the market and avoiding a price war. Taxes are expected to remain at 15% and corporate growth to continue at 12.0%. So this is our side-by-side comparison for our target. And so in summary, Tesla is an innovator. People have lots of feelings about the company, but the stock price has changed from a low of 101 this year all the way up to $313. And they are playing multiple games in the casino all at the same time. And there's a certain type of investor that really appreciates that. So the multiples indicate a very high premium over its rivals, but they've demonstrated an exceptional ability to expand and develop. But maintaining this growth is they're really going to have to focus on containing costs and making precise investment decisions. Opportunities are ample for volatility traders, as much of the stock price movement is due to speculative investment. But given these factors, for a traditional long-term investor, we recommend the recommendation is to sell the stock because it is estimated to be overvalued at its current price. And we anticipate that it is truly valued at 186.39, which is 23% overvalued. And any questions?
Great, Disney, you're up.
I can start it off. I have a quick question. So you all mentioned something pretty interesting regarding the 5 forces analysis. You mentioned that the power of suppliers will remain low, but given the reliance on certain rare earth metals such as cobalt, where roughly 30 pounds of cobalt is required for every battery, and the majority of the world's cobalt is mined in the Democratic Republic of Congo, and nearly 3/4 of these mines have a large artisanal mining component, which rely on child labor. If buyers become smart, or if the government sanctioned these imports, how does a company like Tesla protect their brand while also securing these rare earth metals? Will they innovate out of the issue? How do you think they'll fare compared to their competitors?
So as far as cobalt and the ethics around its mining, that would affect currently the entire EV market. So it wouldn't hit Tesla particularly hard compared to any of its competitors. So with the batteries, if and when that becomes an issue, really, the entire industry would essentially have to innovate itself out of that problem. And so, as I touched on, if somebody is able to develop and patent, that better substitute, then they would have a lot of power as a supplier. But in the automotive industry in general, Ford doesn't make every part of a Ford. Much of it is bought from smaller, or they're called tier 1 suppliers, and it's several companies that sometimes they're owned by a manufacturer. Recently, Stellantis sold Magneti Marelli, which makes every single replacement part for if you have a Dodge, a Jeep, so on and so forth. So sometimes they'll own those companies as like their primary tier 1 supplier, but sometimes then you'll have AC Delco makes parts for pretty much every car, but is primarily owned by GM. GM. Motorcraft is a tier 1 supplier who makes parts for several different brands of cars, but they are primarily a Ford supplier. So by and large in the automotive industry, there's relatively low supplier power, with the exception of if there's a critical technology, like for batteries, that one company has the patent for. But yes, the cobalt is certainly at risk of being a cause due to geopolitical issues, causing a distress for the EV industry.
So you think that a company like Tesla would use their position to potentially buy an upstream supplier to ensure, either safe practices or and to ensure their supply of cobalt, or they just innovate out of the problem?
I don't think, I mean, all manufacturers are sort of aware of this being an issue, that they're reliant on this one mineral from one part of the world. And unfortunately, if there had been, I think at this point, Tesla is not necessarily any more innovative. They have the best battery life, the battery efficiency of their competitors, but they're all using the same core technologies. So they're not necessarily placed in a way that they're going to come up with the solution to removing cobalt and inventing a new kind of battery. And then buying a cobalt mine would potentially lead to bigger international backlash rather than sort of staying at a safe distance and buying from a third party where they can sort of claim amnesty from the practices used to physically remove the element.
Gotcha. Thanks, Stephen.
Right. I had a question. Sorry, I'll go real quick. How long do you feel that Tesla's growth rate can be sustained, and how did you account for that in your model? I know you projected a 12% growth rate for continuing value. That seems quite high. I don't know, maybe with Tesla you might want to, and I know we weren't necessarily supposed to do this with the assignment, but you might want to project a little bit further out before doing continuing value. But how did you feel about how they can maintain their growth rate?
I can take that. If you go back to our as is, we're talking about a company that has increased revenue 50% over the last 5 years, and that is unsustainable. You're not going to double your revenue every year for perpetuity. But given their reinvestment in all these technologies, I mean, if you look at the American ground shipping industry, that's incredibly valuable. And if they start taking over the management of trucks and the infrastructure for the electricity, I mean, the sky is the limit. I think the fascinating part about this company is almost like a pharmaceutical company in ways that they can invest in a lot of different opportunities, and then they can really double down on the force with which they enter. So, for a lot of pharmaceutical companies, one medication makes, the next 5 to 10 years in terms of profits. So there's a lot of differing opinions on the company, but I think 12% is reasonable given what we've seen.
Got it. Thanks.
Okay. I have 2 questions. Number 1, could you please go to the side-by-side comparison for the Assays, Bear and Bull, the side-by-side comparison. The next one. Yeah. Okay. I was looking at this and I was wondering what the major driver of this Bear share price is, because even the growth is still double digits. So could you please talk?
Sure. Yeah. It's basically the revenue and the EBITDA that we expect to change because of the competition and some of the delays that they've had in bringing things like the Cybertruck to market. Also, there's the Model 2, the new economy version of the vehicle, which is going to be cheaper, which has less of a profit margin. But I think realistically with a target, they have to come down somewhat, given that they control 65% of the market. Why they control 65% of the market is, there are different opinions, but their software and their technology and their innovation are really a hallmark of that. But to me, the big difference in the target is trying to adjust as this turns into trying to anticipate the next phase for this company.
Okay, thank you. My
Yeah.
second question is on the tax, cash tax rate. Please show that slide. On the ROIC tree, cash tax rate. Okay, I was looking at 2020 and their cash tax rate was highest in 2020 despite COVID. And it's been in the news that Tesla isn't paying a lot of taxes because they claim their revenues are from overseas. Could you just briefly explain why their tax rate was so high in 2020, even despite COVID?
I mean, I think there's a big change there, but they were also in the negative. So they were losing money in 2018 and 2019, and then with 2020, there was a surge in purchases. So I think they really got caught in having to pay a lot more taxes that year because of the turning around of the company, that it was making a profit and they sold so many cars.
Yeah, I would say that they were in 2020 to keep with demand, less able to optimize their sort of their tax strategy, but coming out of negative years where they're claiming losses on the business, and then it's sort of leveling out to a tax rate that's more common across the industry.
I would also add that for our model, the JP Morgan data that we had didn't give a standard tax rate. We have different tax rate guidance for 23, 24, 25. And then we kind of leveled it off after 2026 and forward. So we did use the varying tax rates for those years.
Okay. Well, thank you, Team Tesla, and thank you, Disney, for your investment committee role, as well as to all the teams. Good job with your presentations tonight. I mean, overall, I think everyone definitely covered all four of the sections pretty well, showed a pretty good application and knowledge for the semester, and hopefully got some good insights from the companies, including even in the last one. I mean, I think I appreciate the comment about whether, 5 years was enough for perpetuity. And I think the real world challenges with evaluating a Tesla, just because even the analysts struggle with this company and understanding their growth rate, because there's just so much uncertainty about it. Whereas, ironically, the Qualcomm team made a reference to NVIDIA. No one's questioning NVIDIA's growth, in terms of how much growth is happening in that marketplace. Yet Tesla is expected to grow, but it's still all over the map. And I think that was even reflective of the various models that showed up in the valuation. So again, very insightful. Hopefully you guys were able to learn something as well in terms of putting these presentations together. It was a great application of what we wanted to cover this semester. So again, well done on the presentation front. So any final comments before we wrap this up?
Do we have some indication as to average of the final, if you have that? Or I know you said you don't, haven't looked at it.
To be honest with you, I was listening to your presentation, so I haven't actually gone in and looked. I can tell you, hold on, let me check real quick if I can get a quick.
Yeah, I figure you have access to it quick.
Let's just see in the auto scoring if it gives me a quick range of where they are. See. not seeing in an easy to explain way, but I'll try and get those grades, like I said, posted fairly quickly as I can before I go under the knife tomorrow.
Of course. Good.
All right.
Best of luck.
Sure. And again, for just general timing, so I'll try and get that done quickly. And then the rest of the grades should be in, I think I owe homework 6 or 7 grades individual. And then, as I said, if everybody gets their peer reviews in and investment committee reports in by Saturday, then late Saturday or Sunday, all the grades will be in, the letters will be out.
Professor, will the final exam, when you release it, will it actually show the answers to the questions? Because I saw my score, but I didn't get to see like the answers.
Yeah, when I post it, you'll go back and see the answers. I don't allow Elms, if I clicked on it right, to post the answers when you do it, just because you could take it early in the week, see all the right answers, and I don't want the right answers getting out there before everybody finished the exam. But if you go back and you'll look, you can see what the answers were versus what you said. That should be an option.
Gotcha, thanks. And also good luck on your operation tomorrow.
Yeah, thanks. Like I said, I didn't want it to get in the way of our presentations tonight, but appreciate that. But as I said, overall, sincerely, you guys did a really, really good job on these presentations. I think you're not only will the grades reflect it, but I think you guys should be proud of what you're able to accomplish and the insights in the companies. And actually, I appreciated the questions that the investment committees made. Showed some good insight into the topics as well. And a couple of teams are really, it's almost like you did your homework on your competitor as well as your own company when you were asking the questions. So appreciate that level of detail that was done. All right. Any other final questions or comments before we wrap up?
Thank you very much for a great class, Professor. Great job. Thank you.
Yeah, I know. Go ahead. Now, I'll take the thank you. I know a couple of you in the first week were kind of grousing that this was going to be a tough class for you because you were not finance majors and you were kind of worried about the process. But to be honest with you, I think overall everybody seems to do a good job and kind of kept up with the materials. So hopefully it was as impactful for everyone here and useful in what you are able to keep on doing. So, just continue reading some headlines and you'll be surprised at how much more you'll get a better understanding of what's now going on with these companies and even the shorter term impacts of their stock prices based on the material that we have seen. So again, thank you again for the feedback. Really appreciate that. All right. Well, on that note, good night, everybody. And again, look for some postings in the very near future.
Thank you so much.
Thank you very much.
Good luck. Good luck.
Thanks. I could use it. Have a good rest of your summer. Bye-bye.